Yeah. We are disciplined. And then having coffee. Do. Hey, trust me.
You be seated.
Date. Yeah.
Good morning. We are back for day 2 of the evidentiary hearing in docket 250712. We're going to start with some administrative matters. I have a couple. In my haste and confusion at the end of yesterday, I realized that I had some questions for the rate-based panel. And I think other commissioners might also. So I was thinking we could start there and then maybe revisit my question about redirect Attorney Bogan after those questions. Does that make sense to you?
Totally fine. We do also have a couple of read-ins that we can deal with anytime you like.
Okay, sure. We can handle those. And the only other thing I had was, I understand Attorney Bowman has an administrative question about a document that was related to the audit, but maybe not in the record. Do you want to address that?
Yes, Mr. Chair, thank you, and good morning. Good morning as well to Commissioners Beecher, Karen, and Cheeseman. Good morning to the company and council, and to OCC and DEEP as well. So in preparation for the allowable expenses panel that we anticipate we may get to later today, authority staff identified a document that was provided to the authority during the October 6th in-person audit that was subsequently requested but not provided in RRU 110, which among other things requests all documents provided as part of this audit plan data request number 25. So specifically, this is a worksheet showing the allocation of 2024 labor expenses among the Avery Dewing companies by employee that contains a W-3 reconciliation. So I'd proffer that this was not a document that appeared in a binder that was tabbed by the audit plan exhibits that had been pre-prepared, but actually one that Ms. Wright retrieved elsewhere as a result of a conversation with Ms. Stober. So we would have put this in through a notice of admitted evidence, but unfortunately the only copy we have marked up. So we would like to proceed and utilize that contents during the panel later, but recognize that all of the parties don't have access to that. So we wanted to gauge the company's amenability to filing it as a supplement to their RRU 110 response. We'd be happy to show our copy so we can help identify that to any of the parties involved, but just wanted to raise this early so hopefully make the panel move more smoothly later on.
Yes, please, if you could please give us a copy so we know what you're referring to. We will see if we can get an original.
Yeah, I mean, you gave it to him during the audit. Yeah. And Mr. Bowman, you indicated that the document was provided in response to an audit request during the audit?
It was provided during the audit, but it was not part of what appeared to be a pre-prepared binder. It was something that arose during a conversation and was subsequently provided. And that's, we suspect, why it wasn't part of the interrogatory.
And it was essentially a document that could have been provided in response to RRU
Correct.
110.
Correct.
We have no objection.
Okay. So maybe Attorney Bowman, if I don't think you necessarily need to do it right now, but if you could circulate that document to maybe company's counsel so they know what we're talking about, and maybe Attorney Bogan, if you could just supplement RRU 110 with that document. And if authority staff has questions about that today, if other parties who haven't seen it yet, could we maybe, Attorney Bogan, would you object to other parties reserving any cross that they might have as to that document for that, once it's filed in the record at some other point in the hearing?
No objection.
Okay. I think that's a easy way to handle that.
Thank you.
Any other administrative matters?
Yes, as I indicated, we do have 3 read-ins. I believe we have read-ins E, G, and K.
Okay.
So with that, I will turn it over to Ms. Wright for, I believe, E and G, and then Mr. Sherwood for K.
Good morning. So read-in E was requesting to see if we had submitted the 2024 tax return. And yes, we did submit the consolidated 2024 tax return in RRU 116B.
B as in boy?
B as in boy, yes.
Okay. Thank you. That satisfies read in E.
And for G, there was some fees of, sorry, I don't.
Yeah, I had that at the Schedule 3.12 other, which is row 24 on that exhibit.
Thank you. So the other 5,000 of that other expenses should have been categorized up in laboratory fees, so it was misclassified. And then the other 2,000 would be USA Blue Book, which is for treatment and equipment for operations. So that's what makes up the 7,000 in other.
Okay, that satisfies read in G, and maybe if the company could supplement, make that adjustment on late file 1, just to for that miscategorized.
Yes, sir.
And sorry, were those the 2? Did we have more?
Yes, mine are,
A third that Mr. Sherwood can provide. I believe that's read-in K.
Okay.
Read-in K, requests were for bidders for the 2023 WICA projects. Correction on the interrogatory 83, there were actually 5 bidders. The bidders, I'm going to give the bidder and I'm going to give their price, just so the authority is aware of the bid process. We had Ludlow Construction at 1.6 million. We had Korea Construction at 1.7 million. We had Caracas Construction at 1.8. We had Avery Construction at 2.3 and Burns Construction at 2.4 million.
Thank you. With that, I believe we are complete with our read-ins for today.
Okay. Thanks. So that satisfies K. And just for the record, I'll just list off what I still have as remaining. It would be A, C, D, H, J, L, and M. Does that match what you have, Attorney Bogan?
Did you say B?
Nope. A, C, D.
I do believe B is still outstanding.
I show it open as well.
Oh, I had that as legal expenses. Oh,
You do?
I thought that was the one where the response was docket 140806.
That was the docket for the parent restructuring. Very
Yep.
well. I
Thank you.
didn't have that marked off. Okay. Did we do I?
Yep, I have that as, that was identifying the ROE study and engineering study as what was other on row 29 of B1.1.
Okay. Then my list corresponds with yours,
Okay,
such as mine is corrected.
okay. All right, so maybe I can move on to some questions I had about rate base, and then other commissioners might have questions too, if the panel's ready. Okay, and I'll remind the panel that you were sworn in yesterday and you remain under oath. It's just something I was supposed to say at the beginning of every hearing. It's not, that has nothing to do with the questions I'm about to ask. My first question is about RU 67 attachment 1, which we talked about it yesterday. It's just a clarifying question, and I'll give you a second to pull that up.
Okay.
My questions are just about columns I and L, which are the beginning and ending depreciation, beginning and ending accumulated depreciation value. What are is the ending, are the numbers in column L, the total accumulated depreciation per project as of when, I guess is my question.
I'm sorry, you're looking at an Excel document? Was this exhibit 067?
Yes, yep,
Oh, you have it.
RU 67 attachment 1.
Can you repeat the rows you're referring to, please?
Yep, I'm looking at column L. And the question was, my understanding is that's showing the ending value of accumulated depreciation per project, but I just didn't know as of what date.
That would be the total accumulated depreciation at the end of 12/31/24.
Okay. And is the beginning value the beginning of calendar 2024? That's column I.
Yes, sir.
Okay. Thank you. I had some questions about the concept of the limited reopener to address the storage tank project. So is the idea that once the project's complete, the company would file something seeking just a rate base adjustment, like just for that additional plant?
It's possible that we'd be in for a limited. It's also possible, due to the time that it may take to complete that project, we may be in for another complete rate case. Being that it could be 3 to 4 years, and we are all seeing how this length of time that we've stayed out already is not very conducive. So it would be either a limited reopener if it's possible, or just another rate case.
Okay. Yeah, I was just curious procedurally if you had an idea of what a limited reopener would look like. Is the idea that it would be reopening this case only to evaluate the prudence of that project and ultimately to whatever, let's say hypothetically, the total requested cost of the project was authorized, we'd adjust rate base to account for that additional plant as of that moment in time and correspondingly adjust rates? Is that the idea?
It also could include WICA reset, as I believe at that point we may be at the 10 or near the 10, requesting a reset.
Okay. Thank you. I had a question about, this kind of came up in some questions yesterday, but and this is sort of like a personal a topic that I keep kind of focusing on probably more than anyone else. Maybe it's a waste of time, but the question is about the exact date that's being proposed for the close of plant. And I think I saw in the testimony, Mr. Sherwood, your testimony on page 6, line 9, the proposal is for that to be the last date of hearing. So that would be we'd be counting plant that's in service as of, would that be June 27th? Because that's the second late file hearing date. Oh, I think I said June and I should have said December. Don't know why. Don't know why I was on June.
Wishful thinking.
And I guess, I mean, you can take it subject to check, is the idea that the request is for like the level of plant that's in service that you're requesting to be the level of plant that's in service as of the last late file, like the last hearing, late file hearing in this proceeding.
Subject to check, yes, that'd be correct.
Okay. The reason I ask is that practically that isn't going to give all parties and the authority the opportunity to actually evaluate that information and ask questions about it in the context of a hearing. So would there be an objection to the date being adjusted to the late file deadline? Because at that point, the deadline by which to file late file exhibits, at that point, there could be, I guess my question is to Attorney Bogan. At that point, all parties and the authority could actually look at sort of what's been submitted and have the opportunity to talk about it.
Yeah, I think I understand where you're coming from. There's been some uncertainty over the last couple of years as to what the last date would be for assets to be considered, or whatever to be considered for purposes of rate-based calculation. And I see your point. On the one hand, what the pre-file testimony suggested was the last date of hearings, but your concern is, well, if you do that, as you just articulated, if Mr. Bowman or OCC or anyone has any questions regarding the inclusion of those assets, there's no opportunity to question. So you're asking if there's an objection if we consider any proposed rate base item as of the date of the submission of late file exhibits, so that if anybody has questions, they can be offered during the late file hearing.
Yeah, and now that I actually am looking at this is why I was looking at the entirely wrong docket. That's why. I was about to tell you the actual dates, but I got to pause on that. Yes, that's my question.
Yeah,
But at the matter of like a week is what we're talking about?
totally fine. No objection.
Okay. Thank you. Yeah, so just for the record, that's the late file exhibits are due on December 11th. The last hearing date for late files is December 12th, so it's the difference of 7 days. I had a sort of a related, just general question about the standard for, I noticed that the company didn't seek forecasted plant additions as part of rate base. So the company didn't include, we kind of got into this yesterday about the difference between the capital plan versus the actual kind of revenue impact. did the company not request that because that's been the standard at Pura historically, that for water companies, there isn't, we're only compensating for plant that's in service as of the record?
Correct.
Okay. And has Hazardville ever gotten through like a settlement or any other means forecasted plants authorized in a revenue requirement?
I'm not sure on a settlement. I know there was a limited reopener in 2006 for the storage tank that was completed then.
Okay, but was that similar to the storage tank we were just talking about, where the actual, like, a rate case was reopened and then only after the storage tank entered service, rates were adjusted, or were rates preemptively adjusted?
No, I believe rates were adjusted after the reopener was completed.
Okay. Have you ever run into trouble financing investments as a result of like that regulatory lag, the idea that you have to incur the costs and then come in after it's entered service?
Not that I'm aware of, no.
Okay. Thank you. And is that, I think you said 2006, has Pura ever done that before? Was that the kind of one time that there's been a limited reopener for a particular project?
For myself with the company, that was the only one that I'm aware of.
Okay. Thank you. All right, that's all. That was all my questions. Just I'll open it up to any other commissioners if anyone else has questions for this panel.
Thank you, Mr. Chairman. I had one just very, very quick question going back to water quality. Do you know of any complaints by the commercial customers? I think you mentioned 500 commercial accounts, or in that range. Have you had any water quality complaints from them that you're aware of?
Not that I'm aware of, no.
Thank you.
All right, that concludes all the questioning for this panel. So I'll ask Attorney Bogan again whether, well, I guess first and foremost, whether you would like the opportunity for redirect on a kind of per panel basis, given that it's the same witnesses for every panel, or if you'd rather just sort of do a total wrap up redirect at some other point. I'll leave it to you.
The latter, I believe. We can certainly wait, if that's okay with you.
Sure. And we can, how about we say it this way? If at any point you would like redirect after any conclusion, that's certainly allowable. Or if you prefer to do it all at the end, that also works for us.
Very good. Thank you.
Okay, so we're ready to transition to the second panel on the agenda, which is cost of capital. And I'd remind, unless there's direct or any opening statement for this panel, I'd just remind the panel again, you're under oath from when you were originally sworn in, and we can start if the panel's prepared for cross from authority staff.
Good morning. My name is Jonathan Norton. I'm with authority staff. Good morning to the chairman and commissioners, and welcome back to New Britain this morning. I have a number of questions this morning related to cost of debt, cost of common equity, and the company's capital structure, which I intend to ask in that general order. So I'm going to start off with cost of debt. In the company's testimony filed August 6th, 2025 by Ms. Wright, the company stated that at August 1st, 2025, the company's embedded cost of long-term debt is 3.96%. That was on page 4 of the testimony. Is this the company's calculated embedded cost of debt for all debt financings that are listed on Schedule D-1.0?
Sorry, we're looking it up. That I have in there, embedded cost is what includes all debt financing. Time on this, so I'd like a read-in for that.
Okay. That's going to be read in N. And I think the question, if you'll entertain me, Mr. Norton, is to reconcile or explain why the right testimony at page 4 shows the embedded cost of long-term debt at 396, but Schedule D 1 shows, it looks to me like the average cost of long-term debt is 3197. Is that the question?
My question is based on their testimony of the 3.96%. My question is, does their calculation of that, was that incorporating all the debt financings listed on Schedule D-1.0?
Okay, so the question is, was the calculation of 3.96 in the testimony accounting for anything other than the D.10?
Yeah, and was it calculated all off of all of the long-term debt financings
Okay,
in the schedule?
does that make sense to the panel?
Yes.
Okay, that'll be read in N.
And just for context, on the question, Schedule D-1.0 shows the interest rates for each one of the debt financings, and all of them seem to be below that 3.96%. So just, really curious what, how we got there originally as well. I don't know if that's something we need to add to the read-in just as an explanation, but if the answer to that is no, my kind of follow-up question to that is, what is the company's embedded cost of long-term debt that they're applying for?
Maybe we can just change read in N to say, provide the basis of the calculation of 3.96 embedded cost of long-term debt reference in the testimony. Would that get to your question?
Yeah, and whether that remains as the cost of embedded long-term debt that the company's actually applying for.
Okay.
I think some of my line of questioning on this might stem from how they answer it. So I'm kind of wondering if it might make sense to convert to a late file. That way I can follow up with some questioning in the future. I essentially have some questions on how, whether the effects of the interest rate swap agreement is also, fully encompassed in the company's application for their embedded cost of debt in that as well. Yeah, it might be better to convert it to a late file as a response so that some further cross could.
So if I may, Mr. Chairman, Mr. Norton, we can proceed in whatever way you think is the most efficient. If you want to try to ask the questions now and see if they can answer them, we can do that. Otherwise, if you want to defer it until you get the more comprehensive explanation to your first.
Okay, I can go ahead and try. Would the company have included the effects of the interest rate swap agreement that the company entered into for the $2.5 million construction loan in its calculation of the embedded cost of debt?
Yes, the 3.76% is the fixed rate. And so we only use that percentage rate for this. The three, is that what you're asking? If we're netting it out?
So the 3.76, to your point, you said was the fixed portion of the loan, which doesn't include any effects of the interest rate swap.
Correct.
So then, I guess my question on the embedded cost of the overall debt of all the long-term debt, it sounds a little bit like you wouldn't have included the effects of any interest earned.
Correct.
Okay, thank you. I'm going to reference the company's response to RRU 145, specifically the exhibit, which shows the quarterly effective interest rate of the interest rate swap agreement. I'll give you a minute to find that.
Understand how to.
And once you get there, my first question is it correct that the company has been earning interest on the swap to date?
Yes, we are earning interest on the swap.
And that would then, if we're looking at just the specific 2.5 million construction loan that's outstanding, that would thereby be reducing the embedded cost of debt below the fixed 3.76% fixed rate on this loan. Is that right?
Can you repeat that? I'm sorry.
So if accounting for the effects of the swap, the interest that the company's earning on the swap, that would thereby effectively be reducing the embedded cost of debt of this long-term financing, the 3.76%.
Correct.
On top of the late file, well, I guess we're doing a read-in still on the embedded cost of debt. Is that right?
Yes.
Okay. I want to ask for a late file exhibit, and I'll try to be as clear as I can here. I was wondering if the company could provide a late file calculation that shows the embedded cost of debt for the construction loan that includes the effects of the interest swap agreement since the loan term actually began, with an explanation of the calculation to go with it. Repeat that if we need.
What I have so far is calculation of embedded cost of debt for the construction loan that includes the cost of the interest swap agreement beginning at the at the commencement of the loan.
At the beginning of the loan term with an explanation for the calculation.
You understand his question?
I just want to clarify, you want us to use the variable interest rate versus the fixed part and see what the embedded cost would look like? You want us to use the
Okay, so
interest
then-
rate that we actually were charged
What you were charged and
without the
then,
swap?
and then netting out what was received to get to, net interest charged or net interest earned, that you can then utilize to calculate the cost of debt on the loan. Does that make sense?
That's not what he's asking. Can I just clarify again on what we just discussed about the interest rate swap? The lowest we can go is the 3.76. They charge more than that. They're charging us more interest. But we use the minimum of 3.76 in our calculation. Or I just want to make sure we're
The higher rate, is it correct that the company's receiving interest on the spread between the 3.76 and whatever the
Yes.
floating rate is? Okay.
Mhm.
So what I'm asking for is calculation of the interest expense at the 3.76%, and then an adjustment down from that interest rate expense by the interest received. That spread essentially to get to a total interest actually charged over the, I guess we would say, the carrying balance of the loan for the pro forma year to clarify, to come up with an actual cost of debt for this loan.
Okay, so we're using the variable rate that are charging us to do this because we're already using the low. So I just want to make it clear that you want us to gross it up.
But they're not actually charging you that variable, you're receiving that, right?
Well, we're paying the variable rate and then they give us the money, the difference. Yes, so we're not paying it. So all of our calculations are based just on the 3.76%, not what they actually charged us for interest. Because they charge us and then we get paid back. So I guess we have the original interest rate of, say, 7%, and then we pay that, and then we get back anything that's above that 3.76.
Can I just ask for clarification? So like ultimately net what the company pays then is the 3.76?
Yes.
Okay. Do you still want that late file exhibit, Mr. Norton?
I think so.
If I may, just so at the risk of confusing things even further. Mr. Norton, am I to understand what you're really trying to get to is the net cost once you factor in the interest rate swap? Or are you looking for something beyond that and the effects of the interest rate swap?
Yeah, and I think I'm gonna have another late file request as I go through this that might be getting at this another way, so it might be helpful to have both still just to compare, but I'm really, really just looking for, yes, what is the interest expense, interest charged less any interest earned at the end of the day, and what was your carrying, what's the carrying value of the loan or average carrying value of the loan for the pro forma year, so that, we can take the numerator and denominator and calculate, the estimated cost of debt on this loan for the pro forma year. That's what I'm ultimately trying to get to.
Okay.
So what I have, just to be clear, what I've written down for late file 24 is please provide a calculation of the embedded cost of debt for the construction loan that includes the cost of the interest swap agreement beginning at the commencement of the loan term. And please provide an explanation for the calculation. Does that work for everybody?
Yes.
Okay, thank you. That'll be late file 24.
I think I have, yeah. Yes, thank you.
I might complicate it a little bit further, but maybe we don't even need to reference this. It's kind of a follow-up question. In RRU 145, I believe the company stated that this loan was subject to an interest rate at the prime rate for the first 2 years of the term. Is that right?
Yes.
Can the company just ensure that those effects are also included in whatever calculation? is put
Yes.
Together. Okay. Thank you. My next questions are on interest rate swap agreements more generally. Has the company made a practice of entering into interest rate swap agreements on their debt historically?
Not that I'm aware of.
Okay, so the company has no historic examples, recent past, that they've exercised any interest.
This is the only interest rate swap agreement that I am aware of.
Okay. Does the company believe the interest rate swap agreements they have entered into is in the best interest of ratepayers?
Yes, we do,
Could you explain why?
because we pay less interest on the loans, so therefore less to carry forward to the ratepayers.
Could you comment on how the company might weigh the potential added risks of the cost of debt when entering into interest rate swaps on long-term debt?
There's a derogatory. Just need to look something up. But this is in RRU 153 explains potential risks. Let me just see. So well, this was asking about SOFR, right? So let's see. I'm gonna have to do a read-in.
That'll be read in O, and Mr. Norton, could you help me with a prompt on that one?
Yeah, just how, an explanation for how the company weighs potential added risks to the cost of debt when entering into interest rate swaps on long-term debt. I think I heard you right that your answer to whether it was in the best interest of the ratepayers, that your answer was that because they pay less interest, right?
Yes, we pay, yes, we have less costs.
That would be less interest than what you would have paid at 3.76% in this instance, is that right?
I don't understand your question.
By paying less interest, you mean the customers are paying less interest than the fixed portion of in this case, the 3.76%.
They're paying the part of the interest rate's 3.76 versus the higher interest rate. If we pay lower interest, it's less expense for the company to pay and on the ratepayers side too.
Okay. I'm gonna move on to RRU 146. Specifically on the potential for additionally approximately $4 million in financing the company is in the early stages of considering for future projects.
Yes,
The company states in RRU 146 that it has not applied for this financing to date. Is that correct?
correct.
Could the company provide a timeline, understanding, in some of the responses so far from yesterday, it sounded like I was hearing, I think, fall 2026 for some of these projects, but could you definitively just give a timeline on when it foresees to be aiming to have this new financing secured?
It'll be sometime after the beginning of the year 2026.
Okay, so early 2026, like in Q1.
When do you, is it, he's saying, is it going to be in Q1? Do you think in Q1 of 2026?
Yes.
Yes.
Okay. So then, does the company have a timeline on ultimately that financing the company will come in for to seek approval from the authority? Is that right?
Yes.
So since this financing is on the horizon, pretty close and upcoming, what does the company expect? What type of effect that this financing will have on its capital structure compared to what the company has applied for in Schedule D-1.0?
That's unknown at this time.
All else equal, I guess, the incorporation of additional debt should lower your equity.
Correct. Increase our debt and lower our equity. Correct.
In reference to RRU 148, company states that it has, quote, secured long-term debt 3 times over the past 10 years. Can the company confirm how much debt was secured for each one of those instances? And the approximate dates, and if not, maybe take a late file on that if you don't have that readily available.
Late file.
That would be the 3 times they've secured long-term debt over the past 10 years from, as stated in RRU 148, just what the amounts were in those instances and the dates they were secured.
I'm sorry, amounts and what?
And the dates when they were secured, that financing.
Actually, I could probably do a read-in on that one. Can we change that to a read-in?
Sure.
Thank you.
That'll be provide the amounts and dates of the 3 financings referenced in RU 148. Was that the reference?
Yes.
Yep.
Yes.
Okay, that'll be read in P. I'm actually going to jump into going back to a question asked a minute ago, just for the sake of we regulators. How would the company propose the questions Mr. Norton was asking a minute ago about this short-term, near-term significant financing and its impact on the capital structure? I have a concern about what we're doing here is we're setting the cost of capital using as best we can, like the accurate capital structure for the future rate year, like the capital structure that the division of debt and equity for the future rate year. So if we expect that that's going to change, do you have an opinion on like how we as regulators should handle that?
No.
Okay. All right. Thank you. Go ahead, Mr. Norton.
Thank you. I'm gonna request another late file. If the company could provide the finalized loan terms for each of the existing 3 long-term debt financings shown on Schedule D-1.0, as well as any additional finalized loan terms related to the interest swap agreement that we were discussing.
So you would like to see the loan documents?
Yeah, finalized loan documents, terms. That would be
Okay.
great.
So that'll be late file 25, and I've got provide the finalized loan terms for the financings listed on Schedule D 1.0, as well as the finalized loan terms for the interest rate swap. Was that the second part? Okay. That'll be LFE 25, like I said.
Thank you. I think I have another request here, and this kind of gets back to what I was alluding to before, a little bit, getting into the embedded cost of debt. And I'm referring to RRU 11, where the company provided a table as a response that we had requested, showing the long-term debt financings and some columns of data that were incorporated in there. I want to request as a late file an update to that table that adds a couple columns. But first, I think in the company's response to RRU 11 for the loan we've been discussing that includes the interest rate swap agreement, there was, I think, just a footnote added for the interest rate there, and an explanation that obviously it was subject to the interest rate swap. And so my first request, generally, I want an update to the table, as I said, with that interest rate for that loan, the amount shown there that you come up with from the prior late file request, if that makes sense. So I had requested what is the embedded cost of debt of the $2.5 million construction loan, including the effects of the interest rate swap in my prior late file request. So I'm asking that this table get updated, that calculated embedded cost of debt for that specific loan be added, and then a few extra columns added to the table that I'll prompt you on here, if that first part makes sense.
So what I have written down for that is update table in RRU 11 to show any impact of calculation provided in response to LFE 24. Does that?
Right, and LFE 24 was the embedded cost of debt of the construction loan.
Yes.
With the swap effects, yep, exactly. And so on top of this LFE request, the two columns of data that I would like is number one, a column showing what the expected average carrying loan balances will be for the pro forma year for each individual long-term loan financing that is outstanding for the company.
All right. I was catching up to you. What was could you say the first column?
Yep.
You're requesting again?
That's the first column would be the company's expected average carrying loan balances for the pro forma year, individually for each long-term loan financing.
Okay.
And then number two, the second column added on showing what the expected interest owed or received will be for the pro forma year for each existing debt financing as well next to it.
Okay. So I'm gonna read
A long one.
that'll be late file 26, and I'll read what I have in total and make sure everyone understands and agrees this is what it's supposed to say. Update table in RRU 11 to show any impact of calculation provided in response to LFE 24. Also, please update table in RRU 11 to include columns for expected average carrying balances for the pro forma year and expected interest owed or received for the pro forma year. Does that make sense to the panel?
Yes.
Okay, that's LFE 26 again. Thanks.
Thank you. I'm going to move on now to some questions on the cost of common equity. Referring back to Schedule D-1.0. In the calculation of the requested rate of return on row 23, can the company explain why all the long-term debt financings are adjusted as of the beginning of the pro forma year, April 1st, 2026, but the common equity portion used is as of December 31, 2024?
Mr. Norton, for clarification, are you referencing the capitalization proportions? Those are the numbers that you're asking about?
Yeah, I should clarify. It's the values that are being pulled into column C of Schedule D-1.0. So the amounts at the beginning of the pro forma year for the long-term debt, if you just follow those down to where they're being pulled from in the lower calculation section, it looks like all of them are being adjusted for the first 3 months of 2026 to get to an April 1st estimated balance of those long-term debt long-term debt financings. But then the equity portion, the six on a cell C21, 6,780,707 looks to be as of December 31st, 2024. So I guess just curious what the company was thinking in general in their presentation.
I believe this came up in an interrogatory, so we're looking to see what that is.
Okay. Um,
Could that have been RU 6? Which asked for like actual capital structure, including quarterly dollar balances as of a couple of different dates.
Mike?
Sure. That'll be read in Q. And it'll be reference schedule D 1.0. And I'll just say, explain the different time periods used to calculate the proportions of debt and equity, the dollar values of debt and equity, and calculating the weighted average cost of capital. Does that make sense?
Yep. Um, so on the same schedule, row 33 of Schedule D-1.0, it shows the company provided estimated activity for 2025, showing an additional $135,000 and $135,177 of net income. Is that right?
Yes,
And the company's estimating the $6,915,000 $884 of total equity as of the end of calendar year 2025.
Yes.
Has the company estimated what the expected equity balance will be as of April 1st, 2026 at the beginning of the pro forma year? I think there's some detail further down that shows it incorporating, I think, through calendar year 2026, which shows an estimated, or I'm sorry, it says here on row 43 at the end of the pro forma year, which I don't know if that's a typo. It says estimated to be April 1st, 2026. Do you mean April 1st, 2027 there? End of the pro.
April 20, okay, 26 is when we anticipated the rates to be changed.
Right, so the effects shown there, the additional 823,000 of net income with an anticipated dividend, $100,000 dividend, would that effectively show the effects of through April 1st, 2027, or is that like through calendar year 2026? What's that representing?
What is that? What did you do on? I'll have to do a late file.
Okay. That'll be late file 27. And it'll be referencing D 1.0. And the question is, just explain the time period
Yeah, so
used to calculate the pro forma balance of 7.639 million. I can let you ask, Mr.
Yeah.
Norton, but it sounds like what
Yeah.
you're asking is like, is that the expected balance at the end of the pro forma year or the beginning of the pro forma year?
Yes,
Okay.
and I have to check that because it doesn't make sense. So.
Okay.
So that's one question, but I think the bigger question, which I think is, I don't know if I have this in a read-in yet, or maybe we can include this in the LFE, is just what is the company estimating for the start of the pro forma year, what their equity balance is going to be? Because it looks like we have it through the end of 2025, but there was no 3-month adjustment done like for the long-term debt here. So it would be helpful to see what they're estimating for, I would assume no dividends, but what they're estimating for at least net income to get to an adjusted equity value.
Can you repeat that? I don't understand what.
So the Schedule D-1.0 shows all the long-term debt balances being adjusted for the first 3 months of 2026 to adjust them for the beginning of the April 1st, 2026 pro forma period.
Mhm.
So I'm ultimately just looking at what is the company's estimate for their common equity balance. What's it going to be also for those first 3 months, after the first 3 months of 2026, starting at the beginning of the pro forma year?
Common equity balance from when?
As of April 1st, 2026. That the company
Through
would,
the end of,
uh,
or as of for, okay.
as of 4/1, since that's what we're looking at for the debt as well, just trying to time everything up, at the same point.
Yeah, for clarification, it looks like on D1, row 39 shows balances at beginning of pro forma year. So the equity proportion would, common equity balance would be 6.915 million, but it looks like that's data as of the end of the, that's data as of the end of 2025 calendar year. So what Mr. Norton's asking for is an update for that to account for the January through April, end of April 2026. So the gap in what we call the interim period between the, well, it's actually more than, it's beyond just the interim period. Just adjusted to the April 1st date. Does that make sense? As opposed to the end of calendar year?
Yes.
Okay. So what I have for late file 27 is reference schedule D 1.0, explain whether the expected balance of 7.639 million shown on cell K47 is the beginning or end of the pro forma year. Please also provide an estimated common equity balance as of April 1st, 2026.
Yep.
Could I talk to my attorney for 1 second, please?
Sure. We just need a second for the court reporter. All right, we're back on the record.
It is not a technical issue. I mean, a substantive issue. It's a logistical or technical issue. The people behind Ms. Wright are having a hard time hearing. So if we could all just make sure we speak into the mic, that will be helpful because they are of no assistance to her if they can't hear. That's all.
Apologies if I was not close enough. Okay. Moving on, in the company's August 6th, 2025 testimony by Ms. Wright, is it correct that the company cites to docket 13-01-29 investigation for streamlining the rate-making process for small water companies?
Can you repeat where that is in the testimony?
Yes.
Page 5, I believe. Line 9.
Thank you. Oh, yes.
And it's this docket that the company uses in its discussion on the basis for its calculation of the return on equity portion of the presented cost of capital. Is that right?
Correct.
And it's the company's position that it has delivered exemplary performance in its inclusion of the variable 50 basis point return on equity adder.
Yes.
specifically in the area of management efficiency. Can the company comment on how it internally gauges management performance? If there's any metrics maybe that the company tracks for its management?
Management performance is determined by the board of directors and executive committee.
Okay, is there any specific metrics, or would that be a no?
Management has to submit their goals for the year, and then it's partly based on, goals met. As far as determining that for management, yes.
Okay. Can the company highlight any areas where it believes its management displayed exemplary performance above and beyond what would normally be expected of a prudent and efficiently run utility?
We could probably provide that in a late file.
Sure, that would be late file 28. And I'll put it as provide examples of exemplary performance above and beyond. I think exemplary performance already means bad, right? Exemplary. Maybe just in support of the requested performance ROE adder. Does that help?
Yeah, that works.
Okay.
What roles or positions within the company are considered management level?
Be president, CFO, and general manager
Controller too.
and controller.
Does management employees for the company take part in any bonus or profit sharing incentive compensation programs?
Does who? I'm sorry.
The management employees of the company.
Yes.
What I guess question on kind of metrics again, would the company, does the board of directors in your case, as you had said, what metrics is being used for determining when bonuses or profit sharing is appropriate from an internal perspective?
The goals that they
Right, but but it's also,
maintain them.
and if we. I mean, we don't get them automatically. Right.
Part of the goals.
Right, so those are part of our goals, but they only bonuses are only given based on performance of the company, the performance of, they're making money so between metrics of, our goals, meeting goals, and the performance of the company are the basis for paying out any bonuses.
The goals met, and then it's financially driven, primarily the company.
Yes, if the company doesn't do well, we don't get bonuses. Has to meet a certain standard, which I would have to check.
Within the last 10 years, has the company ever determined management performance was not sufficient to merit a bonus or any profit sharing? If you can recall.
Yes. Yes.
If there were examples, could the company provide a late file for those years detailing and explaining as to why?
Yes.
Okay, that'd be late file 29. And I'm going to say provide examples of years in the last 10 years, that was a question, right?
Yep. Yep.
Where no management bonus or profit sharing was provided and a narrative explaining why. Does
Yep.
that work?
Gonna move on then to in reference to RRU 19. Some questions on distributions and dividends. The company's response to RRU 19 references that the distribution of dividends is determined in part by the company's cash flow requirements. Can the company provide some clarity on what those cash flow requirements are specifically?
Just cash flow, whether we have the cash flow to pay out the dividends if it's financially feasible
Are
to pay them out.
are there certain levels that the company looks at from a cash flow perspective that has to be there? That there's, is there any policy or anything like that?
Not specifically, we haven't not had, we haven't had any issues, but no, there's no specific policy there.
Okay,
Discretion of the board.
okay. How did the company determine the $100,000 distribution at the end of the pro forma year that we were looking at on Schedule D-1.0?
Historic information in the board of directors.
So historically, that's
In the recent past, that's been how much?
okay. And it says on Schedule D-1.0, show on that line, row 46, showing that 100,000 that it says dividends declared on the description of the line. Is that something that has been declared and confirmed, or is there? I guess I'm kind of also interested in the process of when the declaration is made to the parent company.
At our board meeting that we have at the end of the year, they vote on whether they're going to pay out dividends.
So the 100,000 being shown in that exhibit is not officially declared.
No, it's not.
Okay, thank you.
Can I ask when that board meeting, is the board meeting scheduled for that?
Well, it was supposed to be Friday, but we postponed it till next year because of this.
Okay.
So,
So it'll be at some point, like after the close of record in this proceeding.
yes, I believe so.
Okay, thanks.
The meeting will, yes.
I want to ask for another late file exhibit that shows the total dividend distributions made by year since the last rate case, if possible, or I guess we could shorten that if it becomes administratively difficult on your end, but just with any explanation for any years where it was deemed inappropriate as well to issue a dividend for any years that there was no distribution made.
Sorry, I missed that second part. Were you asking for a narrative explaining why there was no distribution?
Yeah, so since the last rate case, if that's possible, or we could do 5 years, 10 years, whatever the company can do, but what the total dividend amounts were by year and an explanation for any years where no dividend or distribution was made.
Okay, and I think in terms of scope, if it's okay with you, Attorney Bogan, we can put the late file as since the last rate case, but if for some reason that's overly burdensome, we would just we'd accept whatever the company can do in a narrative explaining, we could only do the last 5 years because it was too hard to, to get whatever. Does that make sense to you?
It does. I'm wondering if it couldn't be combined with late file 29, which asks for the years in which there was no bonus, there were no bonuses, and an explanation as to why. We can just include the dividend analysis and explanation as well.
Yeah.
Sure, I can add that onto the 29.
Okay. With that, I'm going to move on to some final questioning on capital structure. The final decision in docket 19-08-01, which is the application of the Hazardville Water Company and the Jewett City Water Company for approval of financing. It states, quote, "The company indicated that they are targeting a 50-50 long-term debt to common equity mix." That's found on page 6 of that decision as well. Does the company recall targeting a 50-50 capital structure ratio from back in 2019?
I don't know the answer to that.
What is the target right now for the company?
I'm looking. We don't have a target percentage. We're just trying to move more towards the 50-50. It'll bring, so.
Okay. And there haven't been any more recent, within the last year's changes that the company has made in its overall long-term debt targets, or whether the company's seeking to retain more earnings on its balance sheet, or expand its equity in other ways. There haven't been any major changes in recent years, have there?
No.
Please turn with me to the exhibit tied to RRU 6. The company's response to RRU 6 on page 2. I'll give you a minute to find that. I'm going to be looking at page 2 of the exhibit provided for RRU 6.
Is page 2. Okay.
Specifically, the company's response under section C, where the company incorporates the approximately $4 million construction loan into the capital structure. Is it correct that the company is showing an equity ratio there of 43.45%?
Yes.
So is this roughly what the company could expect for an adjusted capital structure, assuming it is approved and
Yeah.
assumes the new financing? Okay. And the company does not intend to pay off any portion of existing long-term debt with the new financing?
Not that I'm aware of now. No. Sorry.
I'm looking at page 3 of this same response. It looks like at the end of 2021, the company's equity ratio was down around 48.5% after what looks like the existing $2.5 million CapEx loan was finalized. Is that right?
Can you repeat that? I was looking for where you were.
Yeah, just curious if for 2021, the company's equity ratio was down near 48.5% after it had finalized the $2.5 million CapEx loan,
Yes.
secured that financing. Okay. Based on the response to RRU 6, is it a reasonable conclusion that the company has historically operated with closer to a 50/50 capitalization mix?
Yes.
Yes.
Regarding the construction loan, the new construction loan that the company had indicated was targeting to secure that in Q1 of 2026. The $3,931,277 shown on this exhibit, is it subject to change still at all, or is this a good figure to expect that the company intends to finance in the upcoming year?
Still a good number.
Hmm?
Still a good number.
That's still a good number, yes.
Does the company expect to enter into any additional interest rate swap agreements on future long-term debt financings?
Unknown at this time.
Okay. That concludes my cross. I appreciate your time and thank you.
I actually have one follow-up question, and it's kind of a follow-up question to the question I asked before. Is there, looking still at RU 6, this kind of first section that showing the estimated common equity ratio of 43.45% subsequent to the construction loan. I guess kind of getting at what I was asking before, is there a reason in your opinion why that wouldn't be the appropriate equity proportion to set rates, like for the capital structure for the pro forma year, like given that that's the expectation at this time?
Yes, if that's, yes.
Okay. I mean, so you would agree that it would be rational for Pura to consider that when the rate year capital structure?
Yes. Yes, sir.
Okay. Thanks. Did Pura staff have any more questions?
Briefly, Mr. Chair.
Sure, go ahead.
I'd like to circle back to make sure I understood the testimony on the performance adder portion of the ROE that comes from the streamlining decision. To the extent that decision talks in terms of management efficiency, customer service, and cost containment, I understood your testimony, and please correct me if I'm wrong, to be that the board of directors is the primary determiner of exemplary performance. Is that correct?
Yes.
Okay, and that the testimony was that the board's determination is based primarily on goals. Is that correct?
Goals and performance of the company, yes.
And so that's what I want to get at, because it seems like there's being a distinction drawn between company performance and goals. So are those individual goals unique to each management official
Yes.
as distinct from goals for the company itself?
Yes.
So what, could you give some examples of the individual goals that might be assessed by the board as
Um,
distinct from company performance goals?
like getting the audit done on time, filing the Pure annual reports, doing the rate case. Like these are tasks that I am saying I'm going to complete these goals this next year. And that's what they base it on.
Okay. Are any of the goals, whether they be company related or individually related, tied to customer satisfaction?
Yes.
Not directly,
Oh.
although we do monitor, they're tied both. Oh, let me take that back. Yes, they are. Customer satisfaction and regulatory DPH regulatory compliance. So we have to be in compliance as long as we don't have any notice of non-compliance, Department of Public Health, anything like that.
Okay, thank you. Nothing further from authority staff, sir.
Okay. We are ready then to transition to OCC. And just in terms of, while we're in the transition, in terms of timing, it's 11:30 now. OCC estimates 30 minutes. I have a couple of questions on this myself. So it's looking like when we're done with this section, we'll probably break for lunch. That's what I'm thinking right now.
Good morning, Chair Wheel. Good morning, Commissioners. Richard Sobolewski for the OCC. I have some follow-up from this morning to start. Are the company witnesses familiar with the matching principle? In a rate case where you're trying to estimate rate base, capital structure, expenses, all starting at the same period.
No,
Do you think that's what we're trying to do here? Basically estimate rate base at one point and have the capital structure set to the same time?
yes, sir.
Okay. So in this case, my understanding, and from the testimony this morning, the company isn't looking for pro forma plan. Is that correct? Past the start of the rate year.
Correct.
And in this case, from Mr. Sherwood's testimony, I think you agreed to the cutoff for plant at around the last late file hearing. Is that correct?
That's correct.
And the use of that date by Pura historically is trying to get as close to the start of the rate year as possible. Would you agree to that?
Yes.
So in this case, do you think it would be fair for Pura to take into account more debt or something else that happens in the future if they're not giving you the plan that debt is financing?
No,
Again, trying to match everything at the same point, correct?
correct.
In regards to, I think it's late file 29, can I ask that for whatever period is being used, that the company provide the level of net income for that same year the dividends were paid? So if you're doing 5 or 10 years, that's fine too. Just, if we could just put that in an extra column in it with the dividends.
Yeah, so I'll just add to late file 29. Right now it says, please provide the total dividend distributions made by year since the last rate case and a narrative explaining any year in which no dividend was paid. I'll also just add, please provide the net income per year. Does that work?
Great, thank you. I have a question on the parent company, Avery Doing. Avery Doing owns Hazardville. They also own Jewett City Water Company, correct?
Correct.
Do they still own a gas utility?
No,
And so that has been sold since your last rate case?
yes.
And are there any other operating subsidiaries?
Illinois Real Estate?
Okay. I know in one of either the last case or the one before that, there was a subsidiary East National. Is that
No longer.
okay? In regards to the interest swap that was talked about this morning, was that something that was approved in the 2019 financing?
Yes.
Okay, this is the first, is it correct that this is the first proceeding that Hazardville Water Company has used a simplified ROE method for small water companies?
Yes.
Okay. Are you aware that the company's sister company, Jewett City Water, utilized the simplified method in their 2020 rate case, docket 20-1031?
Yes.
Okay. Would you agree that in the May 19th, 2021 final decision for Jewett City, the authority adopted use of the method and allowed the company a capital structure containing 42.39% debt and 57.61% equity?
I'm sorry, what was that?
Subject to check, yes.
Okay. In that case, the company requested an ROE of 10.44%, which was based on the average of Connecticut Water and Aquarian to be 9.44% plus the 50% size adder and a 50% variable performance adder. Does that sound right?
Subject to check, yes.
Okay. And would you agree in that decision, the authority allowed the company an ROE of 9.94%?
Again, to check, yes.
Now, switching to the current case, if I took the average of Connecticut Water and Aquarian, Aquarian's 8.7%, Connecticut Water's 9.3%, so the average would be 9%? Is that correct?
Yes.
Okay, and allowing the 50 basis point size premium, we're at 9.5%?
Yes.
And if you're allowed the additional 50, up to the additional 50%, I mean, 0.50%, you'd be up to a 10% ROE, is that correct?
Yes.
Now, in the Jewett City case, Pura's decision found that the company didn't demonstrate quantitatively or qualitatively that exemplary performance was there to justify the adder. Has the company provided any analysis in this case to demonstrate Hazardville's exemplary performance?
Not directly for performance, no.
So you haven't presented anything in your testimony or in response to discovery?
I do not believe so.
Now, in prepping for this case, did you do any research on the other companies who've utilized the streamlining methodology?
Yes. Yes.
Do you know what the record has been for the performance adder being allowed by Pura?
No.
Thank you. That's all I have.
And that concludes for the OCC. Okay. I have a couple of questions. Following up on Mr. Sobolewski's questions with respect to the matching principle and the calculation of rate base. I guess I want to ask Ms. Wright, I asked before whether it would make sense for we as regulators to apply to determine the capital structure based on the 43.45% expected equity ratio shown in RRU 6. And I heard the response was yes. After Mr. Sobolewski's questions, is that still the response from the company?
I'm sorry, I don't remember saying that. I thought I was going to verify, but, so we would have to use a ratio that didn't include that financing.
Okay. Would it make more sense to you for Pureit, given, as Mr. Sobolewski has pointed out, given the fact that, well, given the expectation based on the company's application that the plant in service being used to calculate rate base will be cut off at some point within calendar year 2025, would it make sense to you to calculate the equity ratio, the total cost of capital, the total capital structure based on information in the same time frame, like as of year end 2025?
Yes.
Okay. Can I ask the construction loan, the expected construction loan, which isn't going to be finalized until at least, I think, Q1 next year was the testimony earlier today. What is that? Is that for the upcoming tank project that's been discussed earlier?
Anticipated, yes.
Okay. Understood. I had some similar questions to Mr. Sobolewski about the requested variable performance adder. I was looking at the decision in docket number 130129, which is, I think, the origin of sort of the concept. And I saw some language in there suggesting that the adder as envisioned in that docket was for exemplary performance in such areas as management efficiency, customer service, and cost containment initiatives. And I noticed in the testimony in this case that it seems that the proffered sort of justification for the adder here is for improvements in customer service and also in part due to the completion of capital projects. Is that correct?
Yes.
Yes.
Okay. I guess I'm just kind of struggling conceptually with the idea. So that, the completion of capital projects, the kind of revenue impact of that would be the return of and on those capital projects when they enter service. So the company is already, presumably, at least conceptually, afforded the opportunity to earn a return on those investments. So is the request that by virtue of having made those investments, the company should also get an additional adder in addition to the return itself? I guess I'm just struggling with that, struggling with the concept of sort of like adding an additional reward for for the kind of one area that the company is sort of conceptually already rewarded. Could you help me kind of navigate that?
Mr. Chairman, can you just repeat your question? I'm trying to understand. I get the concept. I guess what I'm trying to understand is the baseline that you, in your hypothetical, are asserting is already being recovered, and then you want to add on something else. Like, it's that bottom piece, the base piece that I'm trying to understand.
Yeah, I mean, I think my question is just, conceptually that when a regulated utility makes an investment, makes a capital investment they're already entitled, according to the United States Supreme Court, to a return on that investment. And in fact, the United States Supreme Court has, in the older kind of railroad cases, referenced that return, like use the term reward, that the company's entitled to a reward on those investments. And that's sort of how we get to where we are today, where the opportunity to earn a return on equity on capital investment. So I guess I'm just struggling with the idea of, given that the company already is afforded the opportunity to a reward on investments, I'm just having trouble understanding the rationale for the suggestion that there should be this additional adder because the company has made capital investments. Does that make sense?
And I think it does for me. When you say that additional adder, are you referring to the performance adder?
Yes. Yep.
Okay. Have a moment?
Sure.
Thank you. The end game is that I think if the chair will allow, we'd request we be allowed to respond in the form of a late file exhibit. It does kind of go back to Mr. Sobolewski's question regarding the due diligence in looking at how it's been reviewed in the past. It is a innovative concept coming from that streamlining small water company docket. What exactly was intended by the authority in introducing the concept of a performance adder. And so I think rather than having Mr. Sherwood or Ms. Wright shoot from the hip, we'd be better served by doing it as a late file exhibit.
Sure. And I did, for late file 28, there was already a request from Purist staff, I think, asking for examples of exemplary performance in support of the requested performance adder. So maybe I could just add on to there sort of an explanation for the company's view of capital investments being eligible for the adder. Does that work?
I think that's appropriate. Thank you.
Okay. I also want to acknowledge this is what I'm trying to do, if it isn't clear, is sort of give the company a chance to respond to some of the concerns that I have. And I recognize it's maybe not the best, this isn't meant to feel like cross-examination. I'm just sort of trying to use this as an opportunity to, raise these things. So I'll add to late file 28. Also I'll just say a narrative of the company's view for capital investments being eligible for the performance adder.
Very good. Thank you.
I had a couple more questions on Mr. Sherwood's testimony. on page 9, line 4. It discusses how Avery Doing, and this is a quote, continues to provide management services to the company and to assist in raising equity and debt capital. The question about the statement that Avery Doing assists in raising specifically equity capital, because based on the responses to RRU 9, there hasn't been an equity infusion from the parent in like 25 years. So that's just having trouble kind of reconciling those two statements.
Well, Avery Doing as the parent company of the subsidiaries backs any financing that we have, and that would be how it would.
Yeah, so I understand that it would make sense to me if the statement said Avery Doing assists in raising debt capital, which
Right.
would be the financing. I just wasn't sure specifically to raising equity capital, given that there haven't been equity infusions from the parent. Is it accurate to say that at least in the last 25 years that it hasn't assisted in raising equity capital?
I would like to verify that.
Okay.
And as far as I'm aware, no, but I would have to check.
Okay. So maybe I'll just add a new late file referencing that statement in the testimony and just ask for an explanation of how Avery Doing has assisted in raising equity capital. Does that work?
Yes.
Okay, that'll be late file 30. Sorry, it's hard to ask the questions and record the late files at the same time. I'll also add to that, like my follow-up question was going to be in response to RU 150, the company isn't expecting future equity infusions in the rate year either. So I'll just say like in the same response, I guess what I'm interested in is first and foremost, whether Avery Doing has assisted in raising specifically equity capital in the past and also in the rate year itself, if there's an expectation of assistance in raising equity capital. Other than equity infusions from the parent, does Hazardville have any other access to specifically equity capital? Other than, I guess, directly from rates?
No.
Okay. Okay, that was my last question. Any other questions from commissioners for this panel? Okay. I'll again offer the chance for redirect Attorney Bogan, or again, if you'd prefer to redirect on these questions at the end of the hearing, we can do it that way.
I'll defer.
Okay. So we've got, I think we may as well, we've got 8 minutes until noon. Maybe we can just start on the next panel and get maybe 20 or 30 minutes in before we break for lunch, because it's a little earlier than I expected, if that works, unless the company or any other party would prefer to break for lunch now. The next panel would be O&M. Well, it's labeled allowable expenses, and Pura staff has several hours, so we certainly need to break for lunch in the middle of it.
Okay. Let me take 5 minutes. Let me take 5 minutes.
A 5-minute recess?
Yes.
Sure, we'll just take a 5-minute recess. Are you waiting for me, Attorney Bogan? Because I thought I was waiting for you, and then I realized probably.
I was waiting for you, but.
Okay.
Thank you.
We're all set. We can go back on the record. So are we gonna start? Are you okay with starting for a few minutes? I just wasn't sure if the recess was to discuss anything or.
I apologize. I think we're good to go.
Okay. So we'll start with cross from the authority staff and we'll plan to go to 12:30 for lunch and we'll just see how far we get.
Good afternoon, commissioners. Good afternoon, panel. Salama Bakari for Pura staff. Please turn to your application schedule C 3.11, 3.11. You did, okay. Subject to check, if you look at the cost that you proposing for the rate here, for each of those chemical components, it appears the cost, each of the costs is increasing by approximately 44.6%. Could you explain why the company is proposing an increase of almost 45% in each of the chemical cost components for the rate here?
Mr. Bakari, just so I make sure I'm on the right page, we're at schedule 3.11 water treatment chemicals?
Yes, sir.
Thank you.
So in the test year, the 37 was low because we had wait a minute, no, that's not correct. It was the timing of the purchasing of chemicals. So in the test year, we bought in the beginning of 25 what we would have normally got at the end of 24. So test year 24 was an anomaly because the true average cost per year is more the 50. So we had to account for the fact that the test year was lower than it should have been. Does that make sense or?
To this point, it does.
It-
Do you,
Can I expand on it? The
Yes, please.
Aquadine liquid, we purchased that in late 2023. And that liquid has a tendency to go at least 6 to 7 months for the year before we have to purchase more. So that's why when we purchase that and it extends out into the following year, it's an anomaly that it looks abnormally lower than it should.
Yes.
Turn to your response to RU 96, exhibit page 2 of the worksheet.
Yes.
If you look at the summary for 2023, in Excel row 69, there was a description as that's what the company described as carrots delivery and handling only. Could you explain what that's $1,401 represents?
Hold on, let me
Barrels.
Is the handling?
Sorry, Mr. Bakari, I'm a little lost on, this is our RU 96 attachment.
Yeah.
Yeah,
What I've got is like a PDF that doesn't have,
Oh, okay. There's a worksheet that comes with it, an Excel worksheet.
okay. See if I can find that. Is it for chemical expense?
For chemical expense.
It would be the.
Ms. Wright, my question for that particular delivery and handling expense, is that for August or that expense amount is also for June and July?
What row are you looking at again?
Excel 69, 2023, August.
Delivery and handling.
There's a delivery and handling cost of $1,401. The expenditure also for June and July, or that's just mainly for August?
Oh, let me just look. That. Right, well, it is August, whatever we. Right. That's the- What year? Okay, can we do a read in on that, please?
Yes, please, because I don't see any purchases from that particular supplier in August. That's why I'm asking the question as to whether the D&H cost is for June and July deliveries.
Okay.
All right, so the references are RU 96, worksheet, row 69, and the question is whether the $1,400 is for July and August? Was that the question? Mr. Bakari?
For June and July purchase from the vendor.
Okay. That'll be read in R.
Mr. Bakari, if you could just make sure you speak into the mic.
Okay,
Thank you.
thanks. Also, if you look at the November purchases of sodium hypochlorite, can you explain if those actually should have been for sodium bisulfite? For some reason, the average price does not align with the previous month. Subject to check.
It's line 44, are you talking? For 24 or?
If you like, look at column J and K.
Mm-hmm.
We're now at row 72,
It's labeled.
November 2023.
So can you tell them that is?
So my question to you is the quantities as well as the dollar reported on that line, should that,
Yes, that's misclassified.
so those should have been in the prior column?
Should have been in.
Or the column subsequent to that?
Oh, so it is correct. It's just the. Pounds instead of gallons. Yeah. Okay, so apparently the 10,999 is pounds. It should have been gallons recorded. That's why it looks so out of line from the top ones are in gallons. So that is incorrect for the, I mean, it's not incorrect, but it's pounds.
Okay. So the misalignment has not to do with the chemical itself, because I thought that was supposed to be for the aquadyne liquid, but you're saying that the dollars and the pounds are transposed. One should have been
No, it's not transposed. It's just the units are
in the wrong column.
in the wrong unit measure. They should be in gallons, not pounds. The 10,999 is showing it in gallons or pounds instead of gallons like it should.
So the gallon figure should be in the dollar column, while the dollar column should be in the,
No, we just have to convert the pounds to gallons in that one column. The dollars are correct. It's the unit of measure that they used on that line needs to be converted to gallons.
okay, well, if you convert that 1099.95 to gallon, what should that be? I mean,
I would have to do the math. I mean,
Okay.
this, who wants to know what the conversion?
Can I just ask for,
We'll get that information for you.
so for clarification, I think what you're saying is if you were to figure out what a gallon of sodium hydrochloride
Right.
weighs,
Yeah.
you would divide 10,999.95 divided by that number, and that's the conversion you'd get. Okay. Do you need that, Mr. Bakari?
yes, we do.
But I think the testimony was it doesn't change the dollar value.
Right.
Why it doesn't change the dollar value, it does change the unit cost that the authority is trying to
Right.
determine.
Right, but it's not a calculation. It's just the number of units and then it's got the total that we paid. It's not, it's not a math.
Okay.
So,
For the prior months, prior to November, those units are correct. Is that
yes,
my assumption? Okay. Can the company update this schedule to give us what that volume
yes, sir.
number should be?
Yes,
And I
sir.
think I think the answer, Mr. Bogan's almost objection, I think is the rationale for that so that the authority can calculate an average unit price, a unit cost?
Exactly.
Because without doing so,
Exactly.
they don't have that data. Does that make sense, Mr. Bogan?
Totally fine. The question is, do you want to handle it as a read-in or a late file exhibit? Read-in? I'm told we can do it as a read-in.
Okay. So we'll just say for read-in, just to provide the.
Can I enter?
Right here. Yep.
I got the same thing. Oh, no. Yeah,
That's how many gallons.
1,099 gallons. So,
It appears we may not need the read-in.
so that should be. It probably just has an extra digit in
Do you need a read-in?
it. Not if they're good with the answer.
You want to do a read-in?
Read it, right, do a read-in.
Do a read-in.
Okay, we'll do a read-in.
Okay, that'll be read-in S, and it'll be reference RU 96 worksheet cell J72. Please provide the gallon value.
Turn to application schedule C 3.8. 3.81.
We're ready.
Okay. Could you explain if the company received billings or invoices from DEEP for the 20,568 reported for the test year?
Yes.
Has any of those billings or invoices been provided in this proceeding?
Yes.
You know which exhibits the company provided?
Not offhand. We'll have to find that out.
And we have the filing also as a reading for the company to identify where the supporting exhibit for that 20,568 was reported in this proceeding.
Yes.
Could you explain how the company determined the, oh,
Sorry, Mr. Bakari. So that'll be read in T. The reference is Schedule C381, and it's please provide invoices from DEEP. And was there a second part of that request?
Essentially for them to provide the invoices that support the 20,568 reported for the test year.
Okay. That'll be read in T.
I'm sorry, Mr. Bakari, I'm having a hard time finding the reference in the schedule. You said C-3.8.1?
3.8.
Sorry. Yep, it's 3.8. That was my mistake. So it's column B that I think the question is about.
Excel 20.
Okay. Thank you.
The company is proposing for the deep expense, 16,871 for the rate year. Can you explain how the company derived that amount?
Yes. Similar to the last situation, we paid in 2023, some deep invoices were missed, so they got paid in Q1 of 2024, which overstated that year's actual normal expenses. So we reduced pro forma by that extra payment that we made. Or not extra, but timing.
The deep expense is not an amortization of prior cost, is that correct?
No.
Then explain why the company is including the 16,000 amount in the total amortization expense proposed for the rate year.
Can you repeat that? I'm sorry.
Explain why the company include that 16,871 for deep expense as part of the total amortization expense of 376 that the company is proposing for the rate year.
We add that to the read-in T or Avenue 1.
I don't think the reading is necessary. I just wanted clarification because I'm sure that is a normal expenditure, but
Yeah.
it should not be included as part of the amortization.
The amortization.
So that's just.
Yeah, so maybe I can just add to the read-in, just explain why the deep expense is included in the amortization schedule as opposed to a regular O&M expense. Does that make sense?
Yes.
Okay.
Turn to your response to RIU 87, Exhibit Q.
Okay,
Okay, can you go to page 12 of that exhibit?
okay.
If you look at the top of page 12, there was a summary of non-utility plants, property, plant, and equipment related to Illinois real estate. Is that correct?
Can I just ask again where you are? I don't think I'm seeing what you're saying. This is the financial statements
The
you're
fi-
in?
Financial statement, summary of significant accounting policy on page 12 of 25. The PDF.
Yes, I think, okay. Okay, and it starts with summary of significant accounting policies, non-utility property, plant, and equipment.
PPEs.
Okay.
So my question to you is, why is the property, plant, and equipment amounts for Illinois real estate not included in your math formula in Schedule A 3.0?
We don't put, you're talking about the, we do that at a consolidated level at the end of the year. We don't individually include any of Illinois real estate's financials in our calculations for the companies.
But these PPEs are owned by Illinois real estate, is that correct?
Yes,
So those buildings and lands are assets owned by Illinois real estate, not by any other entity, is that correct?
correct.
Could you identify the entities that the Illinois real estate leased those properties to?
I don't have that information available.
Do you know if those properties are leased to Hazardville and Dewey City?
I don't have that information. I don't do anything with Illinois real estate. I would have to find out.
Can you go to page 9 of that same exhibit?
Okay. Ready?
Okay. Under organization, the last statement on the organization states, ADC also own real estate company, Illinois Real Estate, IRE, whose operation consists of leasing building and land under operating leases to a related party. Do we know which related?
Hazardville Water in Jewett City, the building 41 Taylor Road is owned by Illinois Real Estate.
And Illinois Real Estate received lease payment from Hazardville and Dewey City, is that correct?
Yes. Well, just Hazardville, and then we allocate it, so.
Okay. And those lease payments are considered revenue to Illinois Real Estate, is that correct?
Yes.
For the test year, do you know how much lease payment was made by either Hazardville or Dewey City to Illinois Real Estate?
Well, the testimony, I think, was the payment was made by Hazardville. It's then allocated to Jewett City. I assume you're asking how much Hazardville paid to Illinois Real Estate in the form of rent.
I'm sure that is my question, but I'm sure Ms. Wright knows those amounts we are subsequently allocated, whatever the allocation methodology they're using between Hazardville and Jewish City. So regardless of who pays it, the total amount is still represents revenue to Illinois real estate.
One second, please. Right. Times 12. It's one, right? 9,030. I'm looking for the yearly amount. The yearly amount? 108,000. 108,000. Okay, sorry, 108,000 total for 24 paid to Illinois real estate.
Do you know how much will be paid in the rate year?
Currently it is 99.41 per month. That was effective 11/1 of 2025.
Yeah.
So 99.41 per month.
Chairman, I would like to request a little file for a copy of the lease agreement between Hazardville and real estate and Illinois real estate.
I'm sorry, can you repeat that?
We are requesting for the currently effective lease agreement between Hazardville and Illinois real estate.
Okay, I believe I provided that. I'll see if I'll find it.
Maybe we'll have that as a read-in to begin with.
Yes, that's, I can.
Okay, so that'll be read-in U. It'll be identify record location of a copy of the lease agreement between Hazardville and Illinois real estate. And Mr. Bakari, is this a good place to break for lunch?
Yes, Joe.
Okay. So we will come back at 1:15 after lunch recess.
Oh, yeah, more.
More questions? Yeah, just a little bit on expense. Oh, gosh. I hear better on the left side than five. Step up.
Yeah.
Okay.
That's fine.
Well, I gotta take his seat first, right?
Yeah, I think John's.
I might have to move in because I can't,
Okay, so then he'll know.
can't reach. I think I was talking too quiet. Or I was too far back.
Actually, it seemed to with me because he had a lawyer was saying they can't hear me either, so it wasn't just you.
Yeah. It's like you need to extend this though.
The way your screen looks.
You like it?
Yeah, it's nice.
What do you mean?
Yeah,
The
they
dark?
black- they black- they black.
Well, I feel like it's better on my eyes. Like I don't want.
Actually, it is. That's the.
I don't want to be getting blasted as much. I really should get, some blue light glasses. We all should probably be wearing them.
Yeah.
We're probably all gonna be old and have eye problems.
I know, my son bought me a.
You're all right, right? You're older than me.
Not even close. So my son bought me one high glasses for computer. He said, oh, you stay on the computer for so long, you need these high glasses. But I don't use it, it's in my bag upstairs.
Right.
Okay.
You can do that just right.
Yeah.
All the time. Yeah. the judge, the presiding judge.
Yeah.
Uh, supervisor. Did they post the supervisor role yet?
Oh, they're not gonna put that anytime soon.
No,
Not with the, with the AS works. They work like a slow, they work on a slow pace. I mean, you know. And besides, when you do postings, you'll be on.
We ready to go back on the record? All right, welcome back. We are going to continue with Cross from Pura staff on the expense panel.
Chairman. Welcome back. Turn to your response to RIU 99.
Mr. Picari, is that going to be the narrative response or an attachment?
Add the attachments,
And the Excel or the PDF?
add the Excel,
Okay.
exhibit A, B, and C. If you go to the tab label RIU 099B, and you look at Excel row 10, subject to check the maintenance of equipment, the maintenance expense for equipment that you proposed, $6,014. That's the average of the 5 year. Is that correct?
Yes.
If you look at Excel row 11, can you explain why the maintenance of the SCADA, the maintenance expense for SCADA declined from 9,439 to, that's in 2021, to $1,122 in 2022?
Yeah.
So we're gonna have to get detail on it.
So your question is why it's so low?
Yeah, my question is, why does it decline from 9,439 in 2021 to 1,122 in 2022?
Why does it go down so much?
What's that?
Why does it go down so?
Yeah. I mean, subject to check, it could be that there weren't, equipment that needed to be replaced. You're looking at PLCs and, components within our SCADA that may or may not have had been to be replaced at that time. Again, SCADA is a moving target, as with any sort of electronics. The costs are going to continue to fluctuate year by year. And then as after so many years, 5 or 6 years, the equipment we have is obsolete, and there may not even be repair parts that need to be purchased for it. We may have to start all over again with something. So.
Okay, you just lead to my next question. Given those fluctuations that you experience for the maintenance costs related to SCADA, explain why the company does not use an historical 5-year average similar to what you use for the maintenance of equipment. You use 5 years average for the maintenance expense for equipment, but you're using the test year figure as a proxy for the rate year. If you had used the 5-year average, it won't be 11,133. It would be an average of the historical 5-year maintenance cost of the SCADA. Is that something that the company can do to provide an historical average of the cost of maintaining the SCADA equipment?
Yes. This is the 21 data we have this cycle.
Yeah, he wants to know why we didn't use an average, because
Right,
it
right.
fluctuates.
Yes, SCADA. SCADA. SCADA.
We'll have to get that information for you.
I'm subject to check, just looking at your Excel filing, subject to check, the 5-year average is 7,210, which is significantly less than the 11,000 test year number that the company is using for the proposed rate here.
I'm sorry, where are you looking?
The same Excel row 11. If you look at the 5-year average for the maintenance of SCADA, the average is 7,210.
Something to check, he's saying, yeah, 7.
Where? Yeah, we have to. so- We'll get a read in on that.
Okay, that'll be read in V. And the reference is RU 99. And Mr. Bakari, was the question just why the 5-year average for that SCADA expense isn't proposed for the?
Yeah, the company proposed for the maintenance of the equipment, they proposed a 5-year average and then testified there's year-by-year fluctuation related to the SCADA cost, but yet they were using the test year as the proxy for the rate year. So if there's similar fluctuation between those two components, I think they should be using the 5-year average for both.
Okay, so I'm going to put as the read in, explain why a 5-year average wasn't proposed as the rate year cost for maintenance of SCADA.
Any other maintenance costs been? We did.
And what was the other document you were comparing it, the workbook? Where were you looking at? This.
This is from your Schedule C, Schedule C14, C3.14.
Mr. Bakari, you're looking at Schedule C 3.14, and you're looking at the pro forma year total, which includes a SCADA expense in cell J 17 of $11,133.
Yes, Chairman.
And you're showing, you're comparing that to the,
That's
going back to RU 99 and that same thing, but that matches the 2024 actual in RU 99 and the test year total, right?
Yes, Chairman.
Okay. Does that make sense to the panel, like the question?
Yes.
Okay.
Even RU 99 is asking detailed information.
In your testimony for this response, the company indicated that it will provide copies of invoices to support the test year and the 2025 maintenance expenses. Could you explain if those invoices has been provided?
Yes, all invoices were provided that we said we would submit.
Did the company file an update to RU 99?
We had submitted some invoices last week,
Okay.
supplement to the
So the-
RRU, yes, yes.
Right, thank you.
Mr. Bakari, for what it's worth, it looks like it was submitted on November 26th.
Just for clarification, the maintenance costs for both equipment and for the SCADA equipment, those costs are not allocated between Dewey City and Hazardville, that's correct?
No.
Turn to your response to RIU 98, Exhibit A.
So that would be RRU 98, the Excel attachment and the tab labeled RRU 98A. Is that what we're looking at?
Yes.
Okay.
If you look around Excel row 97 through 102, can you explain why the propane volume declined in 2024 compared to 2023?
Go all the way down here. You got- yes. Why it went down? Well, we haven't completed the. You're asking 24 over 25?
Actually 23 compared to 24.
Oh,
If you look at the gallon for 23 is 81.8. That volume declined to 7460.2 in 2024.
you know, we just use less.
Some of that propane is purchased for heat, so it's also dependent upon degree days. Some of that the propane is purchased for generator use, and rest of it's purchased for heat. So depending upon degree days, the tanks may or may not need to be topped off or filled as often.
And depending on the degree days, that will also affect the overall cost that the company incur year to year. Is that correct?
Say that again, pardon?
Depending on the degree days, the actual cost will also not just depending on the volume, we also decrease from year to year if the degree days are lowered.
It could be degree days. It also could depend upon how often the generators may have to be used during an emergency situation, power outage. So those vary also. So some years, you may have 2 or 3 power outages, generators are running, and maybe you have more other years that you have more time that the generators run. So the generators running, exercise weekly, heat days, and then depending upon how many emergency situations that the generators need to activate to serve, it's all going to be relative to how much propane is used.
Subject to check, if you look at the average price for propane gas, it appeared to increase in 2022 compared to 2021. Is there a reason for the increase?
Well, now he's asking, well, I don't ask. Well, I'm trying to see what. There's 22. There's 22.
Right around that timeframe, the propane supplier Superior was purchased by Osterman Propane. And our costs for the propane increased with that change of ownership.
You mean the change in ownership of your suppliers affect your average price of the?
Well, we're at the mercy of whatever the propane company is going to charge us for the propane and or delivery.
But then the price declined again in 2023 compared to 2024. Is there a reason why there's fluctuation in those prices from year to year on the average price?
That's annual.
What's the average price?
I don't know. Can you tell me what page you're looking at? Because I don't see 22. I must be missing it.
We're looking at Excel row 97 through Excel row 102.
Because that's,
You have the
That's
annual, you
average.
have the annual expenses as well as the annual gallon.
okay,
Subject to check if you were to calculate the unit price on average on a year-to-year basis. You
They have-
see,
They have. They have. They have this one.
Mr. Vicari, just for
I got,
clarification, are you taking like the annual expense and dividing it by the gallons to get that average price?
yes, Chairman.
Okay.
yes, I was just given that same thing. It looks like the price went up in 2022 and it went down in 23 and then rose again in 24.
Okay.
And then again, it's now up again in 25. Why the price fluctuates, again, it's depending upon the supplier. So we don't have any,
For both propane as well as fuel, does the company keep an inventory report of what they purchase and what's left in the tank? What's the cost of what's left in the tank or anything like that on an annual basis, monthly basis?
I didn't know, what do you think?
do you guys record the usage of?
We record what's in our tanks on a weekly basis
On a
to make
weekly-
sure that we are covered for emergencies. Propane company will not deliver propane for our generators unless we call them.
Okay,
So they don't know what percentage of is in that tank
okay.
that we make a
that's-
phone call.
Okay, that's for the
The only
propane.
ones that they refill automatically are tanks for heat.
Okay,
And they only fill a tank to 80%. They do not fill a propane tank to 100%.
do you have a similar weekly report for the fuel oil?
Pardon?
For the fuel oil, do you have a similar inventory report of what's in your tank for your fuel oil, or do you only do it for the propane?
How much, what the size are?
Yeah.
We could get that, yeah.
Okay. Besides the volume, do you also keep the cost of what's in the tank, or you just only keep the volume of what's left in the tank?
We only record the volume what's left in the tank.
So so essentially you don't have an inventory report that show the price of what's left in the tank prior to usage.
No, I don't think we keep any inventory of what the cost was, what's in the tank.
Okay.
I mean, if we paid $2 for what's in the tank and now it's $2.50, we're paying $2.50. Was that your question?
Okay. Can we have for 2025, I'm not going to go back to 2024. Can we have the weekly inventory report for both propane as well as fuel oil to date? What you have in the tank as of November, or from January through November 31st of this year?
How many gallons are in the tank? We could get the percentage of tank capacity off of our reports. And then
When you say percentage of capacity, that will only show the percentage that is filled up, not necessarily, okay.
it wouldn't be filled. That would be what's left right now as of, let's say, today. So I could tell you what's left in the tank as of today.
Do you keep that report on a weekly basis, or you just?
It's reported on our daily reports. We log that daily or weekly. We record that on a weekly basis of what's in our tank.
Okay. Let's get that report for the last 6 months, what you have in your inventory for both fuel oil and propane, just for the last 6 months.
So that's gonna be a late file, I assume?
If
Okay, that'll be late file 32. And I have it as reference RU 99 attachment A, provide propane and heating oil tank capacity data for the last 6 months.
Yes, Chairman.
Mr. Chairman, the reference I have is RRU 98.
98.
Yep. I said 99 because that's what I typed here, but it is 98 attachment A.
98.
Thank you.
Turn to your response to revised RIU 102 exhibit. If you look at the fourth tab label RIU 107, and you go to Excel row 27 through 34,
I'm sorry, do you mean 102?
102,
In which row?
27 through 34.
Yes.
Is there a reason why the meter reading expenses increased from 1934 in 2022 to 7,358 in 2023?
Idea. We have to research that.
As part of that evaluation, can you also explain why the expenditure increased from 7,358 in 2023 to 12,458 for the test year? That's 2024.
Okay, so you want to see why it increased from 2022 to 2023, and then 2023 to 2024.
Yes. Oh, Chairman, that should be, is that going to be a reading or a late file?
That's a late file exhibit if we could.
Okay, that'll be late file 33. And Mr. Bakari, can you help me with that?
This is a revised RIU 102 exhibit. The company should describe what causes the increase from 2022 to 2023, as well as 2023 to 2024.
Yes.
Okay, so describe the cause of the increase in meter reading expenses from 2022 to 2023, and then again from 23 to 24. Okay.
Is the meter reading activity done internally or does the company use a vendor?
I'm sorry, which?
Do you use an external vendor to do your meter reading or does the company does its own meter reading?
We do ours.
Okay,
Company does its own meter reading.
okay. On to your response to RIU 103.
That the attachment or the narrative response?
And actually, I believe this is a narrative response,
Okay.
a PDF page 2.
Sure.
Yes. In part A of that response, there was a reference to storm damage.
Which one? I'm sorry, which number?
If you look at the chart under part A,
I mean, the RRU number. I have several open.
103.
Thank you. And then repeat your question, please.
In part A of the response, there was a chart under part A that says invoice detail for the test year. And there was a reference to some damages. My question to the company is, how much was the storm damage? How much was recovered through insurance claims?
That's the storm damage that we got reimbursed, or that we didn't get reimbursed for.
That is the residual that was left over. I mean, they issued the claim.
Right, but they want to know how much it was. We'll have to get the exact number of the full claim. It was approximately 36,000. And this is the residual, the 4,000 that was not paid for by the insurance company. Yeah.
If you look at your application exhibit C 3.18,
One eight.
in Excel 14, the company is making a pro forma reduction of 7,528. Can you explain how you determine that amount?
We'll have to look at. We'll have to check that.
Oh. When you say check that, would that be a reading or would that be a late file response?
I'm gonna say late file.
All right, so that'll be late file 34. The reference is RU 103. Nope, sorry, we're past that one, right?
It's C318.
Ah, yeah, thank you. C318, and the question is about support for the adjustment
The pro forma adjustment, yes.
to the pumping labor and expenses.
Well, it's
Okay.
a late file now, so. It's a late file now, doesn't matter.
Just so I'm clear, Mr. Bakari, you're asking for how the company calculated the $7,528 downward adjustment?
Yes.
Forma?
I mean, based on their testimony, there was some insurance claim. So the test year expenditures being reduced to reflect what would be a normalized cost for the rate year. So my question for them is to provide all the data that support the pro forma adjustment.
Okay. Thank you.
Also, in your response to 103, there was a description for PO. What does the company mean by PO? Does that mean purchase order?
Yes, sir.
Similar to my earlier questions, the company indicated that they will provide invoices. Do you know if this response had been supplemented by some of the invoices that the company indicated that they will provide subsequently?
Yes, they would have been provided. Same time, I think, as the 26th.
Turn to your response to
We
your,
already did our
sorry.
late file.
Turn to your response to RIU 100. If you have the worksheet, if you go to the tab labeled RIU 100A, and you look at Excel row 10, for 2000 and 2020 and 2021, should those adjustments for transportation allocation be negative?
Not necessarily. It depends. Transportation is an allocation of our transportation expenses that get allocated throughout our accounts. Or no, it's transportation related to, the jobs, and it depends on the amount. It depends on how the allocation goes. It could be positive or negative based on the calculation.
Similar to my question earlier, if you look at Excel row 9, the pump maintenance costs decline between 2021 and 2022, but then increase again in 2023. Is there a reason for the changes in this expenditure?
I'm sorry, where are you looking?
We look at it, Excel row 9.
Top line right there.
And you look at the cost in 2021, 22, and 23. There are changes. There was a decline from 6,593 to 2,951. Then in 2023, the amount from 2022 increased to 10,671 in 2023. Is there a reason for this major fluctuation in between those expenditures?
Road work.
If I may, Mr. Bakari, are you asking the reason for the substantial decrease in 2022 and then the increase in 2024?
There was a major decrease between 2021 and 2022,
Right.
and another significant increase from 2022 to 2023.
Yep.
So what's causing this major fluctuation in those expenditure between those years?
So in 2021, we had a charge from that's landscaping. This is our landscaping people for road work at stations for $3,730, which is the main and then so that's why it was high in 21. So it went down in 22 because that 21 was just an anomaly. And then
Structures.
And then we have-
Additional maintenance. Structure, and then this was replacement of a.
so we had replacement of a furnace in 23 of 1,090. And then we had a couple more from Garrett's Carpentry for, it had to do with replacing a door. So that's why it went up, back up in 23. So basically it's, additional work that we don't normally have done that fluctuates as needed.
Thank you.
That's not a touch screen. I mean, it's basically those. Right. Yeah.
Repairs outside bounds.
Turn to your response to RRU 97 exhibit.
$97.
You look at the fourth tab where you summarize the annual expenditures. Can you explain why the expenditure went down from 55,369 in 2023 to 44,803 in 2024?
Which account?
This is Excel row 20.
Oh, the net.
What is this for?
And we have to analyze what's in the account.
Okay.
Because this is a big, I see that operation and labor went down and the payroll went down. Which is, payroll is based on what work they do and where. And so that's the big one. We'll have to see. 642 seems like the biggest. Did we talk about 642?
Can you explain if the expenditure related to water treatments have any correlation to the level of water produced and consumed by your customers?
The cost of water treatment?
Yes.
Yes, it's reflective upon the amount of water that's used for the expenses.
For the last 3 or 4 years, has the consumption increased or decreased?
Consumption by the customers has decreased the last 3 or 4 years.
Similar to the discussion we had earlier regarding chemical expenditure. So if your consumption by your customer decrease, so the level of chemical treatment required will decrease, is that correct?
No, your consumption will decrease, but your expenses increase. Chemical costs, everything increase.
But the quantity of chemical that you are using,
Pardon?
the quantities of chemical that you are using to treat the water will decrease to reflect the level of consumption, is that
The
correct?
amount will decrease, but the cost continues to rise.
But let's assume we're going from one period to another period, say 2023 to 2024, and then 2025, and then into the rate year, and the consumption continue to decrease, but your prices for those things stabilize absent inflation. With the costs continue to increase or decrease?
If I may, Mr. Chairman, I'm going to object a little bit because I think what the witnesses testified is, yes, consumption has gone down, but costs have gone up. So there's no one-to-one correlation between a diminishing consumption pattern and cost.
Okay.
I'm gonna sustain and I'm gonna find that it's been asked and answered because I think I understand at least that the testimony is essentially, sure, consumption goes down and then that does reduce the level of, in the case of chemicals, the level of chemicals that are necessary to be purchased, the volume, but that if you have corresponding cost changes, then your overall total cost doesn't necessarily coincide with the reduction in consumption. Is my understanding correct?
Yes.
Okay, does that satisfy your questions?
Yeah.
Good afternoon, this is Maria Schul again. Thank you for letting me ask this question. I would like to refer you to a response to interrogatory RRU 127, please. Attachment. Please let me know when you are there.
I got it. Yeah.
Okay, we're ready.
All right, so now you presented unit price for the chemicals that are used for treatment. Those are 3 last columns of your table. And this is for years from 2021 to 2025, October, I believe, yeah.
It's that way. I don't know how to fix this, but
20. What is the question?
I will ask you a question now.
Oh,
So let's go first to sodium bisulfite. When we look at this column from year 2021 to now, the price of 1 pound of this chemical did not change much. And actually, if it went from, see, it was 0.31 cents, 0.32 cents, 0.40, 0.40, 0.41, 0.41. So the price per pound is the same, did not increase much. And then when we go to sodium hypochlorite, it's similar story. And then when we go to aquadene liquid, it's a little bit more than, it's probably about 16, 17% increase between years 2023 and now. So how can you tell us that the price of chemicals increased so much? We need to look at unit price, and your treatment depends on the year. If it's drier year, you use more water for treatment because people use more. If it's a wet year, people usually use less water. So we don't argue with the amount of chemicals used. We argue about units of price.
yeah, no, but if you go back to the original rate case in 2009, these are not the prices from 2009.
But we are talking about prices for the last 6 years.
You're talking about the price for the last 6 years, but the base rate and everything we're talking about is related to the rate case from 2009, not necessarily the last 5 years. We're telling you that the cost of chemicals have increased since 2009, 2010 decision exponentially to what they are today. Yeah, I'll grant you the fact that they don't change much within the last 5 years, but that's not what we were paying for them prior to the last 5 years, going back to the previous rate case. That, you could argue the same fact with electric costs. We're paying a smaller electric cost in 2010, and we're paying a higher electric cost in 2025.
Would you be able to provide the cost of chemicals since last rate case per pound unit?
I'm not sure if we could, but we can try.
So how did you figure out that it's gonna be 45% increase?
that's 2020 to 20.
We'll have to get that information for you.
May I ask for late file, please?
Sure. So maybe the panel, if possible, maybe the late file could just be to update only columns P through R in RRU 127, just to show, again, if possible, the unit price going back to the last rate case, or as much data as you could get. Does that sound, I mean, I know you can't answer whether it's possible now, but does that sound like a reasonable way to?
We'll do our best to go as far back as we can. The 45% is based on the increase from 2020 to 2025. For if that's what you're referring, maybe.
Okay, so that'll be late file 35. And it's reference RU 127. Please provide the unit price chemicals dating back to the last rate case And can I just ask a follow-up, Ms. Wright, to what you just testified, that the 45% is based on the increase from 2020 to 2025? Is that like the average?
If that, is that 45%, Maria, what you were referring to for the Aquadine, the 45% increase?
It's not 45%, it's about 17%. If I look at the prices for the past 4 years.
So this average is,
No, actually, no, it is 17%, 16, 17%. If you look at all the 6 prices since 2021,
okay.
because average is 1.13%, $1.13.
Yes. Okay.
The 45% goes back to your exhibit C 3.11. You're proposing for almost 45% increase from your test year cost to your rate year cost.
Maybe I can. I was going to suggest that I could just add to week LFE 35 to just explain the pro forma adjustment in C 311. Would that also just sort of, that's sort of like a backstopping in case, depending on the chemical data you're able to find, and also give you an opportunity to provide a narrative explanation if that's necessary.
The next question has no particular exhibit, but it has to do with your customer in Rye Hill. Could you explain how the company procure the water used to service customer in Rye Hill?
How the customers,
How do you procure the water that you use to service those customer in Rye Hill?
Purchase.
Or you purchase from
Purchased through a transmission main from Connecticut Water.
Connecticut Water? Do you have the invoices from Connecticut Water that shows the purchase water cost for the test year?
we should,
We could get that.
yeah, we can get that.
For those customer in Rye Hill, how do you bill them? You bill them your purchase price, or do you bill them your residential customer rates?
We bill them at the residential customer rates that are approved by the authority for the Connecticut Water Company.
Can I just interject one moment process-wise? I think there was a request for the invoices. Did we want to give that a late file designation?
Oh, yes, please.
I-
Sorry. That's
I was typing it out. I was right about to get there, Attorney Bogan. That can either be late file, I assume since it's invoices, that can't be a read-in, so that'll be late file 36. It'll be, please provide invoices showing purchase water costs from Connecticut Water for Rye Hill system in the test year.
The cost of the purchase water for the test year, do you know which particular SFR schedule that is reflected in this application?
I'm sorry, which what?
The cost of the purchase water from Connecticut Water, where in your SFR schedule did the company reflect that purchase cost?
Just for clarity, SFR means standard filing requirement. So the question is like this, is there a C schedule that shows that cost?
Oh. Who do we get it from? Oh, it's the Connecticut one. I have no idea. It's there, but I gotta see them somewhere. I thought that's what he just said. Right. Okay, 602.
But it's not.
This is for the what we're paying. Okay,
Excel spreadsheet.
I don't know.
No, because we know it's not included in our base rate.
Right, yes. The purchase water, yeah, that's not in our rate base. And help me here, Bob. We don't include, no, it's not in there.
I have a follow-up actually on Schedule C 1.2. Looking at row 15 as meter sales for Rye Hill, and I see that they're backed out as an adjustment, and I was wondering if that's related somehow to, I mean, it looks like the revenue is backed out of the test year. I don't know if that's somehow related to the fact that the water has to be purchased.
Yeah, it's backed out because it's not our rates.
So does that, well, I guess that still doesn't account for the expense side of like purchasing the water. It just backs out the revenues, right? So I guess the question, Mr. Bakari, is whether the expense is reflected somewhere on the income statement.
Yes, it would be. In general, yes, normally it would be yes, so it would be a net effect of the two.
So maybe could that be handled through a late file one? Like if the company could take a look at the, whether the effect of that expense should be reflected on the C schedules? Would that make sense to you, Mr. Bakari?
Yes, it does, yeah.
So just so that I'm clear, are we looking to see if the expense associated with the purchases from Connecticut Water should be separately broken out and reflected in the C schedules?
Yes, I mean, it seems the company is reducing its proposed revenue requirement for those costs, but I would rather have the expenses separately and the revenue reflect what it is, which is the revenue they're getting from the sales of water to those customers in Rye Hill. So instead of reducing your proposed revenue for the effect of the purchase water cost, that purchase water cost should be separately identified as the cost of water purchase from Connecticut Water, and the revenue should, maybe the net effect is zero, but right now I need to see what the company actually purchasing from Connecticut Water and how much is being taken out.
Let's see how much we're getting out of
Yeah.
it.
Yeah, I think Attorney Bogan, the way I see it is if the company identifies that it is reflected in a C schedule already, just maybe not identified, then maybe the edit could just be to add a note saying, oh, this is in outside services or something, and this is the amount that's, the proportion of that amount that's attributable to the water expense. Or if it's not in there at all, then that would just be a correction to the.
Yeah, I appreciate that. I assume it is reflected. It's just, as you said, not broken out as a separate line item. It's captured simply as an expense.
Yes, that's correct.
Chairman, that's all my questions.
Is that all for authority staff? Oh, all right.
Jonathan Norton again with authority staff.
Mr. Norton, can I ask you to
yes.
pause for 1 second? Because Ms. Olson just asked me a question. I want to make sure I'm clarifying. I'm understanding. So in late file 36, we're going to give you the invoices for the expense during the test year. The question secondarily is whether or not there should be a late file 1 adjustment, even if it's in the form of a note to reflect that some expense category captures the CWC expenses. Okay.
Yes, and I didn't add that as a separate, I mean, I think I see that as encapsulated within late file 1, so I didn't see it. I mean, I could add a note in late file 36 if it's helpful as a reminder, but I see it as I kind of see any edit to the overall schedules filed as a late file is within late file 1, if that makes sense.
I'm good. Thank you.
Okay.
Good to see you again. Good afternoon, Jonathan Norton with authority staff. Just some questions, hopefully as briefly as we can be on interest expense. Some of the, at least one of the questions I have might sound a little bit similar to this morning, but it'll kind of lead my my line of questioning. So in regards to Schedule C-3.22, back on the topic of the interest rate swap agreement, and in reference back to the company's RRU 145 interrogatory response. The company states that the terms of the swap require the company to pay a fixed interest rate of 3.76% and to receive a floating rate of interest with payments calculated on a notional amount that mirrors the outstanding balance of the outstanding debt throughout the life of the swap. Close quote. So based on that response, is the company effectively stating that it is paying interest on this loan at a fixed rate and then receiving interest payments on the spread, but that in both scenarios, the interest owed or paid is being calculated on the outstanding balance during the reporting period? Realize that's.
Can you please state that a different way?
Yeah, so is it the company's response that that it's paying interest on the fixed side of this loan that is separate from the swap, and then subsequently receiving interest payments on the spread between the market rate and that 3.76%. But that in either case, that's being balanced out at the end of the reporting period. Is that what the company's?
Yes,
Okay. Is the reporting period monthly for the company?
yes, we perform a monthly close.
Okay. For the interest earned on the swap, RRU 145 states that the company is recording this as other comprehensive income or loss at the end of the accounting period, correct?
Correct.
Could you explain the exact accounting entry made by the company and how it flows through as a credit? I guess specifically the swap portion, how that flows through as a credit to interest expense as shown on Schedule C-3.22.
Right, yeah. I know. Yeah. I know. I know that. Yes, I know that. Yes, the income offsets the interest expense.
So
Interest we receive, so we pay whatever the variable rate is to the bank, take it out. And then we receive the spread, the difference.
okay.
So, and then, so the net effect each month is the 3.76%. Is that? So when we book the total payment, including, the full interest, and then when we receive the cash, we offset the interest expense account with that. And then as far as, what was the last part?
Just was kind of alluding to the accounting entry. So it sounds like whatever the net effective interest is, which looks like based on the numbers is going to produce an actual interest expense when you net the two, between the actual cost of the loan and, the interest received on the swap. You're going to be debiting your interest expense, and then you'd be crediting other comprehensive income
No,
essentially.
we don't put it, the auditors do the adjustment at year end for the other comprehensive income transaction. We
Okay.
do not, we just put it interest expense in and out.
Okay.
And at the end of the year, the auditors book that other entry to put it to that
Okay.
other comprehensive income. I can get the entry for you. I'd have to go back and find it, but I can get that if you'd like to know.
No, that's okay. I guess I'm just curious because it's being recorded on the balance sheet, and maybe I'll learn more about this when we get the late file on the terms of the swap agreement, but I'm just curious when that comes off the balance sheet and is actually officially recorded as income, the portion of interest earned on the swap.
That would be that other comprehensive income adjustment at the end of the year from the
So it comes
auditor.
off the balance sheet at the end of each year, gets
It should,
recorded as
yes.
interest income.
That portion, yes. Yes, I believe.
Okay. So it's not just a credit to interest expense as a contra expense, so to speak. It's
Internally it is, externally they do the adjustment to move it to comprehensive.
at the end of the
Yes,
year.
at the end of the year when they do their audit.
Referring again to this Schedule C dash 3.22 of the application for interest expense. Why is the interest related to the CapEx debt for WICA shown on row 25? Why is it dropping so significantly between the 2024 test year and the pro forma rate year?
All right, we're doing some research. Can you please repeat the question?
Why is the interest related to the CapEx debt for WICA on row 25 of Schedule C-3.22? Why is it dropping so significantly between the 2024 test year and the pro forma rate year?
I know that. The principal comes over. Right, that's not what he's asking though. It's just the reduction of, I mean,
I would expect it to drop a little bit as you pay down the debt, but just curious why so much?
we'll have to come back to that.
Okay.
That'd be a read-in, maybe.
You're reading? You're reading? Or read-in? Late file, please.
Okay. That'll be late file 37. And the reference is Schedule C 322.
Mhm.
And the question is, please explain the reduction in CapEx debt for WICA between the test year and the rate year. Is that right?
Mhm.
Okay.
I'm gonna refer to the Excel exhibit provided for RRU 24. And specifically on page 2 of that response. I can give you a second. Try and find that. My question. Well, my statement first is, it looks like the company is, in calculating the pro forma interest expenses for the outstanding debt. It looks like you're using a mix of accrued interest for its long-term debt finance, or actual accrued interest from prior periods, as well as estimated values from its bank amortization tables to come up with the average monthly interest value for calendar year 2025. And then ultimately, it looks like you're annualizing it to come up with a pro forma year interest expense. Does that sound generally right?
I believe so. We're looking into it.
Okay.
Mr. Norton, can you catch me up on what exhibit we're looking at? I was typing in.
Yeah, RRU 24, the Excel exhibit provided on page 2.
Okay, thank you.
I can repeat the question as well.
Yeah, if you could.
Yep. So it looks like the company is using a mix of its accrued interest, actual accrued interest for its long-term debt financings, as well as estimated values from its bank amortization tables to come up with an average monthly interest value for calendar year 2025. And then annualizing it to basically, forecast it for the pro forma year interest expenses. Does that sound?
So you're saying, are they using 25 as a basis for the pro forma, the 25?
Well, it looks like
Mix, well, it's all interest, it's accrued interest is our interest expense.
yeah, it looks like you're partially using actual accrued interest, and then in some cases, like if we were to look at column O, you'll see that there's values taken from the amortization schedules from,
Correct,
okay. So it's a mix that's being used,
Correct.
but it's also primarily using 2025 values, correct?
correct.
Okay. So as the company pays down its long-term debt into 2026 and the beginning of the pro forma year, we could expect those interest expense values to come down, correct?
Correct.
So with that said, could I request a late file that that utilizes and I'm not sure you have this, but the bank amortization tables that would show the expected interest expense values for the pro forma period to get, a more accurate interest
We-
expense for the pro forma year?
Okay, yes, sir.
Okay, thank you.
That'd be late file 38. And what exactly is the support for the expected interest in the?
So it's in reference to, we were referring to RRU 24, the exhibit, but the request is for the company to utilize their bank amortization tables for the pro forma period. So I think that would be 4/1/2026 to 3/31/2027, utilizing those amortization tables to come up with an estimated interest expense for each one of their debt financing, long-term debt financings.
Okay, what I've got is reference RRU 24 attachment, using bank amortization tables for the pro forma period, please derive an estimated interest expense for each long-term debt financing. That work?
For the pro forma year, yeah. And then I just have last two questions. Does the company also utilize a revolving credit facility to help cover immediate cash flow needs?
We do have line of credit with Hazardville. Yes.
Okay. Where would any of that interest expense be located on Schedule C-3.22? If you could point me in that direction. Maybe the other line potentially?
Oh, I'm sorry, I think I got out of the workbook. Oops. Yes, this interest expense other for the line. Is that the line of credit? It's all up here. I know, just the line of credit though. Is that the line of credit? Yes, this. No, that's not it. That's the drinking water fund. The line of credit interest. Well, there isn't much. We. Interest is in this line, all interest. No. I'm checking.
No problem.
We don't have a spot. It's all. I know that it's all in one account. I get that. They want to know. You can tell. 123 is. If they want to, okay, so it's all in this account. Okay. Yes. It's all included in the top, okay, the line or row 14.
So the two,
That includes all interest expense on loans. Except for the generator one. So interest expense other.
okay.
Let me see what's in this.
So that's being derived down below as the pro forma year 208,117, is that right?
Yes, that's, yes.
Which, do you know which row 24, 25, or 26 that interest would fall in?
Top line of that
Okay.
long-term debt, row 24.
Okay. 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 I think that's all I have. Thank you.
I wonder.
Still working.
There is line of credit interest. Used to be. And they used to put it there.
Okay. I'm Diane Stober, Pura staff, and I just have three questions. The first is if you can if you can pull out the attachment to RRU 126, and then also the SFRC 3.1. And RRU 126 asked about 4 different positions.
Ms. Stover, could you repeat the C schedule? that you-
Sure, and it's C 3.1.
Thank you.
Okay, so my question is, on C, if you're looking at C 3.1, and if you take a look at the column titled Projected 2025 Pay for those 4 positions. And actually, I can first go back to the column changes from 2024 to 2025 for those 4 positions. So it would be lines on the Excel row 27, 28, 31, and 32. And when I compare the changes from 2024 to 2025 column on C 3.1, it agrees with the RRU 126 attachment, the column way over to the right that says reference schedule C 3.1 changes from 2024 to 2025. So so those agree. The columns that don't agree, and I just need to know why, is the projected 2025 pay on C 3.1 and the amounts on RRU 126 attachment for total 2025 projected earnings. I would think those would be the same, but they're not.
Can we just go through them? So on C 3.1, senior accountant, D is 55,855, which
Right,
coincides with that one. Same
Exactly.
thing with controller.
yeah, those, the changes from 2024 to 2025, that agrees every time.
Oh, okay, sorry.
It's just the projected 2025 pay, in every case, C 3.1 is substantially higher than what is on RRU 126. And RRU 126, the column says total 2025 projected earnings. So maybe I'm missing something. Maybe you're defining that differently than you are on C 3.1.
So we're comparing column F in C 3.1 against column K in RU 126, right?
I'm going to take your word for it. I don't have the Excel on. Okay, thank you.
There's 3. Yeah, I think I'm going to need to look into this because you're correct, they are different, but I'm not sure. I have to see the basis. I don't know why it's not the same.
Okay.
So I can't answer that question without doing some research.
You think it's a read-in?
No, I would suggest, Ms. Stober, probably be best advised as a late file exhibit. And if we determine that there was reconciliation that's required, it would be a late file 1 adjustment.
Just a second. It's hard to type out this late file between the 2 exhibits. Just 1 second. All right, what I have here, it includes Excel column references, so I know Ms. Stobart
Okay.
might not make sense to you, but what I have is reference RRU 126, explain why the amounts in column K differ from the corresponding amounts in Schedule 3, C31, column F. Does that make sense to the panel? Okay, that's
Yes.
late file 39.
Okay. Okay. So the next question, the one that gets to the document. If you're ready, are you
Yeah,
ready?
I'm
Okay,
ready. Yeah.
so you probably want to pull out RRU 3. And I know that you supplemented RRU 3 after we were out there on audit. And then also if you could pull up C 3.8.1.
No, there's a 3.8.1.
Okay, all right. So on this supplement, the RRU 3 supplement, that was where you then corrected to specify that the company overtime row on C 3.8.1 is company labor that is not on, and you modified that to say that RU 3 was supplemented to state that test year overtime of 1,400 shown on C 3.8.1 is not included in payroll shown on C 3.1A. Because originally it said all payroll is on C 3.1A for the test year. That's okay. Sure. So RRU 3 supplement, it was supplemented to say that the test year overtime of 1,400 that's shown on C 3.8.1 is not included in the payroll shown on Schedule C 3.1A.
That's correct.
Okay. And so my question gets to that piece of paper that I was provided on audit, and I don't know if you were able to locate that.
I thought.
Paperwork that you took a picture of.
Is that the one that Mr. Bowman showed me earlier?
Yes.
Yep.
Yeah.
Yep. I have to.
And so you
locate
will,
that.
so you'll be able to supplement that response. I think that was RRU 118 or something, where ADR 110, where ADR 25 was provided. And that's what I had as part of ADR 25
Yes.
when I was out there on audit. So on that piece of paper, the bottom left, it does a reconciliation of the total payroll shown on C 3.1A. You look at the bottom left of that sheet to the 941s that were filed in RRU 118 as attachments to RRU 118, all the quarterly 941s.
So what do I need to be looking at?
So what I'm asking for you to look at is that, here's my question. The 1,400 that's on C 3.8.1, I don't see how that cannot be included already in C 3.1A, because C 3.1A was reconciled to your federal quarterly reports. And it was not there was no reconciling item for $1,400. So what I'm questioning is the payroll, has it been double counted on 3.8.1 and on C 3.1A?
Well, 3.8.1, the 1,400 is, 1 minute, please. Okay, so there is an error there. This was supposed to be, I thought it was for pro forma. So you're correct, that 1,400 is in the payroll. I thought it was pro forma, so that, you're correct.
So you can reflect that on LFE 1
Okay.
when that gets filed. Okay.
That's a problem.
That's okay.
Go ahead.
Okay, and then the last question, it doesn't relate to any specific exhibit. So when I was out there on audit, we had a discussion, and I'm hoping you can just elaborate here about how the employees do their time, because payroll is charged directly versus the mass formula. And we know the mass formula, certain things are done with the mass formula.
Correct.
But the payroll, if you can just talk about how employees actually charge their payroll.
So employees fill out timesheets on a weekly basis and their hours get allocated directly to the accounts that, well, to their job, whatever job it is, they put the associated payroll GL code on it, goes through payroll, and so the actual hours worked are what we use for allocation.
And that would be in addition to their position, but also to each entity, like Jewett City.
Right, so we have an intercompany for Avery or Jewett, or, so if they worked doing work for Jewett City, they'd put those hours under Jewett City, and the associated code pays all through Hazardville. And then we do a journal entry to take, out of that intercompany bucket and put it to a journal entry into Jewett to allocate it across the correct accounts.
And then before the payroll gets processed, do their supervisors review their timesheet to make sure the coding is correct?
Yes, they do.
And that's all for me.
Thank
Thank you.
I just ask a follow-up on that. So it's not like for payroll purposes, then there isn't really a Massachusetts formula because you're direct coding the actual hours, but the mass formula is used for all the other allocations.
Correct. We do allocate one of the payrolls for the board chairman through.
Okay.
But other than that, everything is actual hours.
Okay, thank you.
Can I just ask a follow-up then? So payroll is done exactly how you said, but and I know benefits follow the mass formula, but don't payroll taxes follow payroll?
No, we allocate the payroll taxes. We do that allocation at the end of the year, I believe. We just put our, wages
Exactly.
And then we do a true up at the end of the year, including payroll taxes that allocates out to them.
Okay, let me ask my question a different way. then.
Okay.
Are payroll taxes allocated based on payroll or based on the mass formula? Or some other thing?
Employer, what?
Your taxes based on
Yes, employer taxes are based on the are the allocation formula, the mass formula.
On the,
Use the mass formula for the payroll taxes.
okay. All right. I think,
Are you 100% sure?
I don't have my, there's an exhibit, there's an SFR for payroll taxes.
Right, employee follows.
I tell you what, Mr. Chairman, while they look for that, perhaps we could take a 10-minute break.
Sure. Let's take a 10-minute recess and we'll be back at, we'll do a 14-minute recess and be back at 3:10. Just felt weird to be back at 3:06. So. We ready to go back on the record? Okay. Ms. Stober, I think you.
Okay.
If I might.
Man, twice you've been shut down.
Well, she said she was done before. It's okay. It actually relates to that because I think Ms. Wright wants to correct a statement that she made earlier in response to something that you had asked. So the floor is yours.
Sure.
Thank you.
Thank you. So the last conversation we had about the allocation of the payroll and the payroll taxes, I think I want to clarify, I want to correct that statement. The payroll taxes get allocated based on the percentage calculated of payroll that was allocated to Jewett City. The Hazardville payroll allocated Jewett City, and then we get the percentage of that. And we take the total payroll taxes for Hazardville and we allocate that amount for taxes at the end of the year. So does that make more sense than what?
Yes,
Okay.
yes, it does. And just to follow up one thing then, because I want to have the last word here now,
That's
but
fine.
just to follow up one thing.
Is
So
this the last word?
This is it. This is it, and I won't say any more. C 3.21A, I think is yes. If you can just take a look at that. Because to me, that is where you are calculating the payroll taxes that are included in the pro forma rate year,
Correct.
which is done based on specific employee positions payroll,
Correct.
right? Okay.
Yes.
Which is a little different than when you do the actuals. That's my only point. This is following the exact, like if you were to go down a position, let's say an open position, and if that were to zero out, the payroll tax for that position would also zero.
Correct.
Okay.
Yes. Yes.
Thank you. Thank you.
Good afternoon. Josiah Wada from the authority staff. We'll be continuing with the O&M expenses. If you can turn with me to schedule C 3.6, row 18, line 18. If you are there, let me know. Employers Association, is it a trade association? Or what is your relationship with this body?
It's a Players Association of the Northeast. They are the association that is a resource for human resources issues and what else? They basically are human resources contact if we need information or have questions. And there's a monthly meetings. So it's,
So they are,
I mean, it could be for any employer. It's not necessarily a water trade association, but it is an association.
just an association, not a trade association.
No, it's not a trade association.
Can I have one moment, Mr. Chairman?
Yes.
So, and these fees, this association, we don't have an HR person, not a designated HR person. Or we can use them for legal resources, so we don't have to use an attorney.
So you expect that the expenses will be recurring in the rate year?
Yes.
Then RRU 129. B's specifically. If you are there, let me know.
That was 129.
Yes, 129.
Okay.
Yeah, your response indicated that the Connecticut filing that you did to the Secretary of State was for ADC.
Correct.
Okay. I'm requesting that, and you also indicated in C of that interrupt that it will not be reoccurring. Is that correct?
Whether the expenses in C above are recurring expenses. Doesn't make sense. I'm just a little confused because in the interrogatory and the question, C says whether the expenses in C above are recurring expenses. I know it's
Is it recurring or non-recurring?
right, but it says in C above. Where is C? That is C as far as I can tell, right?
Yeah, you indicated that the Connecticut State filing was for ADC. The
Yeah,
expense
so
was for
it is
ADC.
non-recurring because it is for ADC. It
yes.
should have been charged to AD. Yes.
Okay, so I'm requesting that you revise your filing and LFE 1 to reflect that $450 will no longer be recurring, to be zero. Is that okay?
I think Mr. Wada, as like an initial question, maybe I can jump in. If the expense is not expected to recur in the rate year, does the company feel it's appropriate to include it? Or I guess the question is, should it have been pro forma adjusted out of the rate year if it's not going to recur in the rate year?
Yes, it should have been
Okay.
adjusted out.
So maybe if that, Mr. Wada, do you know the schedule? It would be in the outside services.
3.6.
Okay.
Line 20.
Okay. So maybe just the request is, if applicable, to adjust schedule 3.6
to zero.
To remove that expense if it's not expected to be incurred in the rate year.
Yeah, I don't know why we put that in there. Okay.
In other words, I mean, I don't want to do the work for you, but I imagine the solution would be to put 435 negative as a pro forma adjustment to that line and then have zero as the rate year, the
Correct.
pro forma. Yep. Okay.
Yes.
Okay. Can we move on?
Yes.
Ready? Okay. Schedule C 3.8.1.
Okay.
I'm looking at lines 13 to 24. One of those line items shows mail notices to customers.
Yes.
My question is, how is this mail notices different from the monthly customer notices that you send along with the bills?
He's like, he said, what's the difference? This mail, this is part of the pro forma rate case expenses, and we have the notice that we mail to customers. We have something there, and he's saying, what's the difference between that and your like other monthly notices or whatever? I mean, these are specifically for the rate case. Well, that's, yeah, it was the notice about the hearing. We had done this before we had them take over, so this is what was budgeted for the pro forma. So he's, so we. This is what we have for mailing notices. So we had it in the last one. I don't know what's still on that. Okay, sorry. This 4,800 specifically rate case notice expense, the others would be just inserts if we had to do a mailing for customers. So this was specifically for the rate case mailings.
Okay. Will it be anything different apart from separating the expenses to determine which one is rate case and which one is the normal? It's still O&M expense. So
Right.
maybe it can show up just in like the normal expenses, even though it is requested or mandated that you send such notices for rate case items. Okay, that's all right. That's fine. Whichever way you treat it is fine. I just wanted to know why it showed up here. My next question
Can I
is,
just ask that you don't think that those notices should be at all factored in because we have to pay to send notices? Is that what you're saying? Because we send
no, but you still incur
right?
monthly monthly bills that you mailed out. So it should have been added there as an extra cost, and then be treated as just one expense, mail out expenses. Okay, instead of
I understand.
separating it to be a rate case item and then O&M.
It could have gone with, yes, and not have the extra expense. Got it.
So in the same schedule, the last line there, we have order. The rate case expense there, we have order for $750, is it? $750. So what does that order represent?
So the 750 is just encapsulating anything that may not be covered in one of the other categories. If we had to have something printed up or it's just doesn't fit in any of these other categories. And it's just for anything that comes up unexpected.
And my next question is, you propose to amortize the total rate case expense in 3 years. Do you consider the impact of Public Act 23-102 in respect of this expense.
We would have to look the act up. We don't know what that is.
I think that's also, it is a legal question. Maybe that might be, I defer to you, Attorney Bogan, but that might be best addressed in a brief. Because I think the question ultimately is the company's sort of legal position as to whether these expenses are barred from recovery by current Connecticut statute, which again, I don't know. Doesn't make sense to me to have that as testimony as opposed to a legal argument.
Yeah, I would agree. I was comfortable with the question and the response, which was, did you consider it? If he wanted to go beyond it, then I probably was going to say that's more appropriate for legal analysis. But if that's the implication here, we can certainly deal with it in the brief.
I mean, I have no implication personally one way or the other. So I guess I'll ask Mr. Wada, are you more interested in whether the company, whether the company staff who prepared the rate case considered the legal implications of these expenses, or are you more interested in the company's position with respect to whether these should be recovered?
Yeah, I'm interested in the company's position as regards these provisions of the law.
That would be objectionable. That calls for a legal conclusion. But we can deal with it in the brief.
Yeah, thank you. Yeah, I would request that issue just be raised in the company's brief. Thank you.
Okay, Schedule 3.3.
Sorry, Mr. Wada, one more interruption. I had a question just going back to the mail notice, the $4,800 expense on 381. And I'm sorry if I missed this. Was that like a separate mailing or was that a bill insert? Like were these incremental costs, were there envelopes stuffed and stamped specifically with just these notices?
This was for the hearing notices specifically to the rate case.
Okay, thank you.
And they went singly without anything, not an insert.
Gotcha. Okay, thank you. Go ahead.
Schedule C 3.3. Excel line 19.
Yes.
The test year figure is showing 15,000. And the company is proposing to make an adjustment of 12,000 for employee profit share. And then when you extrapolate the figures, it shows 82% increase. So
Pro forma is incorrect.
okay.
That's the total profit sharing, and it should be the net after allocating to Jewett City. So this 28 is not all for Hazardville, but that's what was put in the pro forma. So there's an error in this amount.
Yeah, because I was thinking that maybe the year looked very great, and you are proposing to.
Well, no, no, it's an error.
Be a great employer to your employees by moving up the profit share by 82%.
No, that's not what. So yes, I can tell you right now that is 28,000 is the full profit sharing, that a portion of that will get allocated out to Jewett City. So that number is probably going to be closer to the test year number than what it is.
So that will be a late filed one adjustment.
Yes, if you can revise that. Then I have RRU 132.
I'm sorry, 122?
No, 132. Miscellaneous general expenses. Excel line 8. we have the, are you there?
Yes.
We have the 2025 CTRWWA. And the figure there is included in Schedule C 3.9. But it is also included in orders. When you are trying to show the breakdown for orders, this CTRWWA was also included as a separate line item in Schedule C 3.9. So is that not duplication? If you compare RRU 132 to Schedule C 3.9.
So we've got CTR, WWA, we got the same. Oh. Why is this 510? So the 775 is also
In
in the C 3.9, that is line 23.
yeah, it's
And
listed there
then
in C
directors.
3.9.
I'm sorry?
It's listed there in Schedule C 3.9, and it's also included in the amount for orders. In RRU 132 is showing the breakdown of what that orders contain. And then you included this same CTRWWA for the same amount.
I get it. Right. Well, they're not the same, I don't think. Oh, I see. Got the whole this in here plus this here. I understand. You're right.
We'll take a look at that. It may be another candidate for late file one adjustment.
Yeah,
Thank you.
yeah, I think that,
Oh, so
so that should either, I mean, that may either need to be backed out of line 31 in other expenses or line 23, I'm referencing Schedule 3.9. Either line 23 might need to be eliminated or line 31 might need to be reduced by 775 if the company confirms that
Well,
those are in fact
I
the
was going
same.
to say that the witnesses might be able to answer it now.
Okay.
Well, it looks like the whole 2038-32. Oh, I see what you're saying. So I gotta make sure there's nothing else duplicated too. That is in this other, make sure there's not anything in there. Because BOD expenses, we got it here. I don't know if,
These aren't in there.
okay.
You need to find out what makes up that number. So this would.
Well, this is what makes up this number.
I understand that, but
You want to read?
and then you're still
Right.
gonna come up to that number. This should not be the.
Well, I'm not gonna come up to that number.
It appears it is a candidate for an adjustment.
Okay, thanks.
RU 131. If you are there, let me know. Okay. Your response shows that directors and officers liability insurance coverage is meant to protect personal assets of the board members and executives. And my question is, how does this coverage benefit ratepayers?
The
I'm
coverage.
going to object to the question. The response speaks for itself.
Going to sustain as to that question. I mean, I think you could ask if the company has anything to add to what was provided in the interrogatory response.
Yeah, the company provided that the coverage protects the personal assets of the board members and executives. But, and now you want to recover the cost of this coverage in this proceeding. Is that not right?
Yeah, I'm going to reiterate the objection. I mean, it is in fact the question that is posed in subsection C, and the company answered it.
Yeah, I agree, Mr. Wada. I see the subsequent sentences for the answer to C do appear to be the company's justification for the ratepayer benefit from their perspective of these expenses. So again, I mean, I think we have the answer to that. I mean, it says recruitment for the positions would be more difficult absent this cost. It references financial stability in the event of a lawsuit. So I think if we have further questions beyond that answer, you can ask them. But I think the question you're asking now appears to be answered by the interrogatory response.
Okay. We move to Schedule C 3.6. Under the same insurance expense. So I believe I should defer on this question since you provided the response in the interrog earlier, but I wanted to know by comparative analysis, the benefit, because it benefits both shareholders and you stated ratepayers, but I wanted to know the proportion of those benefits. So
I don't understand the question.
the question is, you stated in your responses that you needed the excess coverage to deal with catastrophic matters. And my question is, this benefits both the company, shareholders, and the ratepayers. So my question is, what is the proportion of benefits?
Well, I'm going to object because the response doesn't say that the coverage benefits the company. The question was posed as to how it benefits ratepayers, and that's what this response speaks to.
Yeah, I think maybe, Mr. Wada, if you want to ask an initial question of whether the company feels that any portion of the expense benefits the company, maybe that's an initial question that we need first before asking about proportions.
Well, okay. Yeah, I can revise the question. So does this excess coverage, does it benefit only ratepayers or does it benefit the company as well?
I believe it benefits both.
And then back to my question. What is the allocation of these benefits? What percentage, how proportional or what is the composition of these benefits, if I would say? Does it benefit ratepayers more or it benefits shareholders more?
If you're able to quantify it like that, you can. If you cannot, you say, I cannot.
I can't quantify that.
Okay,
Sorry.
that's fine. I think that's all that I have here. Thank you.
Thanks. I actually have a follow-up question to that. It's sort of another probably annoying sort of regulatory policy question, which is that, and this question isn't based on a foundation that I feel that any one way or the other about the recoverability of that D&O liability expense. Like that's something we have to determine at the end of this hearing. But if we were, I'll back up a little. PURA sort of historically has determined that particular expenses, that the recoverability of certain expenses should be shared between shareholders and ratepayers. For example, board of directors expense sort of historically before that was specifically disallowed by statute. There's a lot of decisions that kind of split that 50-50. With the acknowledgement that the company recognizes that this particular expense sort of benefits both, is there anything, could you help us figure out, like because now we have the responsibility now to figure out like, well, what do we do with that, right? Like if it's not entirely beneficial to customers, then we have to ask ourselves, well, should customers pay 100% of it? And if we determine maybe not, then what do we do? Like we find ourselves in a situation where all we have is sort of a dartboard to throw something at. So I guess I'm asking, like, is there anything you can do to help us with navigating that question?
If it's acceptable to the chair, we can provide some narrative that hopefully will be helpful in the brief.
Sure, that would be great. Thank you.
Nothing further from staff.
All right. We can transition to OCC's cross for a panel.
You want to take a minute? Oh. Just go. Just go. While they're getting set up, Ms. Wright's going to take a moment, if we could. Just go.
We ready? All right. Please proceed.
Thank you, Mr. Chairman. I just wanted to update the authority that our estimate is 4 hours on the schedule, but we're down to an hour-ish.
No
Very disappointed to hear that.
I figured that would be received warmly. Thank you.
Hi, I'm Rory Apolloni. I'm an accounts examiner for OCC. So my first question is, was there a financial reporting problem that caused the company to terminate the previous treasurer, CFO?
No.
Okay. Is the company aware of why the previous controller and senior accountant decided to quit the company?
I'm gonna object only because this seems to be intruding upon matters that are exempt from public disclosure under the Freedom of Information Act. So that if there are questions related to that issue, we should probably do it in a closed session, since it involves a personnel matter. I will also just note that the witness just responded that it had nothing to do with any financial impropriety. So I think that would be the relevance in as much as this proceeding is concerned.
Yeah, I mean, I agree. I think if we could, well, I'll let Attorney Manikowski respond if you have a response to the objection. Okay.
Okay, thank you. I'm going to refer to OCC 2 payroll by position, page 2 of 2, and OCC 59 answer.
Sorry, Mr. Apollonio, I got the OCC 59 part, but what was the first reference?
Yes, OCC 2 payroll by position, page 2 of 2.
Okay, thank you.
Okay. It appears from this exhibit that the senior accountant performed 0 work in 2024. Can you explain the timeline of when the senior accountant quit and how that matches with the answer provided in this interrogatory response?
Can you repeat the question, please?
Yes. So it appears from this exhibit that the senior accountant performed 0 work in 2022. Can you explain the timeline of when the senior accountant quit and how that matches with the answer provided in the interrogatory response?
The senior accountant left in 2022 as they were part-time, and I'm not sure what their reasoning for leaving was.
Okay, thank you. So I'm going to refer to OCC 59 and OCC 60 answers. Here, my question is, when was the senior accountant's last day of work?
Senior accountant's last day of work was October 15th, 2021.
Okay. So follow up to that, can you explain, I'm referring to the same responses here, so it's 59 and 60, the conflicting dates in the separate interrogatory responses as to when the senior accountant left the company?
Well, there are 2 different occurrences. The senior accountant left, and then that person came back at the end of 2023, which is why there was no wages for 22. So they came back at the end of 2023, part-time, full-time as of January 24, and then left in March of 24.
Okay, thank you.
So it's a little convoluted.
Yes, that's why I have questions, but thank you.
Yes.
Yes, so A follow-up to that, just to be clear, I'm referring to OCC 2 payroll by position, page 2 of 2 spreadsheet. So the senior accountant got paid in 2023, but was previously quit in 2021, and you're saying was rehired again?
Correct. In October of 2023.
Okay, and this person was hired to the same role that the person quit from?
Yes and no. The roles were similar, but it was in a kind of a higher capacity when she came back. It was full-time and it was involved more jobs, duties.
Okay, thank you. So I'm going to refer to OCC 61. Why does the company believe it was appropriate for the term controller to train the new treasurer or CFO?
The
Is that just your standard practice? If somebody leaves, the person trains the next person?
the person that trained me was there when it was a different person than who we just discussed. And she left 2 weeks after I started. So the only interaction I had or training was that 2 weeks. And that was mainly in her functions because I didn't have anybody train me in my functions. So we worked together for 2 weeks.
Okay,
And then that person left, and then the old senior accountant came back.
all right, so this lady that trained you was the controller?
County manager, controller, yes. Same type, same thing.
Can you briefly give me a description of the training this person gave to you, the treasurer, CFO?
She educated me on the payroll, accounts payable, banking. It was mainly training in the functions that she performed because I wasn't going to have anybody and I needed to either do it or train somebody else. So she was training me in her functions.
Okay, thank you. Is the current senior accountant the same person as this senior accountant that quit 2 times?
No,
Okay. Did the term senior accountant that quit 2 times did the person actually quit, or did the company tell this person that there was no work to be performed in 2022?
quit.
Quit. Why does the company believe a senior accountant would work part-time?
So the senior accountant that left in 21, she couldn't work full-time. And then when she came back, she couldn't work full-time until the beginning of the year. So when she came back, it was not intended to be part-time. It was just an interim part-time. But before that, that was all she could work.
Okay, thank you. Can you provide me the term senior accountant's educational background? Just briefly, did she study accounting?
She was currently in school to get her accounting degree.
Okay, she didn't have it when she was
did
a
not.
senior accountant.
No.
And she was studying accounting? What was she going
Yes.
for? Yes?
Yes, that was her associates in accounting.
Okay. So how many of your employees in the last 5 years quit and got hired again at a later point in the same position?
That would be it, just one.
Okay, and this is the senior accountant?
Yes.
Okay, referring to OCC 63 answer, can the company explain its rationale for hiring a part-time accountant instead of getting an accounting temp from a temp agency?
Well, this is saying a 4-year period of 13,991, but that's not, that's because that person wasn't here for a period of time and they were part-time. So but there was another salary in that. So that person only had that much compensation in that 4-year period.
Okay,
So that's why that's what it's asking is why we would need a full-time senior accountant, but we need a full-time senior accountant and controller in order to perform all the functions of the department.
okay, and before you hired this senior accountant, which was part-time, and quit in 2021, did you consider or did you evaluate the costs of hiring this person and going for accounting temp?
I was not here in 21, so I don't know what the rationale is.
Okay, thank you. How much money did the company spend on onboarding and offboarding the term senior accountant 2 times?
Can I ask you to rephrase it, Mr. Apollonia? Perhaps a predicate question would be, did the company incur any expenses in training the employee?
Did the company incur any expenses? I wouldn't say training, but hiring the employee 2 times?
No.
Okay, thank you.
Thank you, sir.
Thank you. So I'm going to refer to OCC 65 answer. What work caused the controller's position to go from a part-time position to a full-time position at an annual salary of $49,783 increase?
So the reason for the pay increase is because the person that was hired in the controller role was hired to take on functions of the CFO so that the CFO, myself, can do other things that I'm supposed to be doing. So, and that person has the credentials and the background and experience to be paid controller salary, which she is a controller. So that's the reason for the increase. The other people in that position did not have the credentials or experience.
Okay, thank you. So I'm going to refer to OCC 68 answer and OCC 2 payroll charged by position spreadsheet. Can you explain why the company's answer in OCC 68 that the chairman was also the president of the company, but it is correct that there was also an actual president on the payroll who got paid $154,334 in 2022? Just seeing an issue.
I apologize, Mr. Apollonia. Could you repeat the question?
Yes. So I'm referring to two answers. So it's OCC 68 answer and OCC 2 payroll charged by position spreadsheet. So in OCC 68 answer, it stated that the chairman was also the president of the company. But if you look at OCC 2 payroll charged by position spreadsheet in 2020, there was a president that got paid $154,334, and there was a chairman that was paid as well. So why are you saying the chairman was also the president if you have a president?
So at the time, the president was John Avery. And then we have so the reason for the confusion is because the titles have changed. Like in 2020, the board chairman was the president. And the president was the general manager. Currently, the former president is now the board chairman and the president is different. So they both would have still had wages. But like I said, the board chairman on the spreadsheet was the president in 2020 and 21, right? When did he change? He was the executive vice president. Oh, you were the executive vice, okay. So titles have changed. But they were both employed with the company at that time. So that's why. Does that make sense?
Somewhat, but
So-
thank you.
Okay.
Please, if you could expand further. So the current president was not the president. So what titles changed, if you could
You
briefly
were, what is
tell me
it,
that?
executive?
In 2020, that position or that title would have been considered to be executive vice president in 2020. And then the chairman slash president 2020, which is Mr. Avery, was still the chairman president.
Okay, thank you.
So then you carry that across, and when Mr. Avery retired, and then the board elected me president.
So if you look at over the years, how it went down.
Okay, and
Yeah,
Okay.
it's just title changes over the years, which flow across. So it looks different.
thank you. So I'm going to refer to the same answers, which are OCC 68 and OCC 2 payroll charged by position spreadsheet. Can you, I'm a little confused there. Can you explain why a new board member was added to the company in 2024? You say this in OCC 68, but if you look at the OCC 2 payroll by position spreadsheet, it shows that there's been a chairman and 2 board members for every year from 2020 to 2025.
So what's the question?
Yeah, it's just the OCC 68 answer doesn't seem to be matching up with your spreadsheet, which is OCC 2. You state that there.
Well,
Go on.
sorry.
No,
No.
go on.
That board member, the new board member's not on here. Because that board member only gets paid they get their fees. They don't get paid out of the payroll. So these people, board chairman, board member number 1 and 2, like one of the board members is the secretary, one's so they have roles in the board aside from being board members. So they get a small stipend, but all the other board members, including this one in OCC 68, they wouldn't be listed on here, the rest of the board members, because they don't get paid through payroll.
Okay, thank you for that. Just a couple follow-ups. So you're saying, and correct me if I'm wrong, but OCC2 payroll charged by positions spreadsheet, that doesn't have all your employees listed. You're saying there's more board members?
Board members don't get paid. Which is-
These two do, the others don't.
These get paid out of payroll. Board chairman gets paid through payroll, but does not get board fees. Board member 1 and 2, these small, they get like small amounts every week, very small for like secretary. One of them's the secretary. And then she gets fees. But when we pay board fees, they get paid out of accounts payable and booked directly to the ledger. They don't run through payroll. So they're not going to be on this schedule if they don't get paid through payroll. So the only ones that have any payroll are the 3 top. And then, sorry, the rest of the get paid separately. 1099s.
Okay, thank you. Just one moment. Okay, so I'm gonna go to OCC 70 response. Can you explain why the board chairman's pay has a high volatility?
As I previously said, the board chairman was previously president, and so his salary went down when he stepped down from the position, and then it went down because he, in '24, so to compensate for the additional board member. So that's the reasoning for such a big decrease over that time.
Okay. Are all the Avery family members board members?
I'm going to object to the question. I'm not sure what you mean when you say all of the Avery family members.
So your entire family of Averys, are they all part of the board?
Maybe is the question, is the board comprised of, maybe the reverse question, right? Like our, yes. Yeah, I think maybe a more appropriate question would be, is every board member a member of the Avery family?
Okay. Thank you. So is every board member a member of the Avery family?
No.
So I'm going to move away from board members here. I'm going to move to another topic. So I'm going to refer to HWC 2025 rate case exhibit spreadsheet C3.9 admin miss general expense tab. Okay, and my question here is, what makes up the $2,828 of directors' meeting expense?
Those are expenses related to attending the board meetings, such as flights and mileage and gas and food.
Okay, thank you. Are the current senior accountant and controller considered at-will employees?
Yes.
Okay. Did the company make any legal guarantees or contracts with the current senior accountant or controller that they will not be laid off after this rate case is completed?
No.
Okay, did the company make any legal guarantees or contracts with the current senior accountant or controller that they will not get their hours reduced to part-time employment after this rate case is completed?
No.
Lastly, actually not lastly, but in the last 5 years, did the Hazardville Water Company's core operations significantly expand?
Are you referring to people?
Your business operation?
Yeah, I'm going to object. The question's overly broad. If you could narrow it, the witness might be able to answer.
Okay, have you significantly expanded your staff?
No. Yeah.
Okay,
I'm sorry. Sorry.
one moment. All right, thank you. I'm done with my questions.
Good afternoon. I'm Albert Zablowski from OCC. And I'm sorry to disappoint, but I have yet another payroll question. And I'll refer you to interrogatory response OCC 92. And in this interrogatory, OCC asked what the approved payroll capitalization ratio was in the last rate case. And the company responded that there was no mention of the approved payroll capitalization. Does the company mean it wasn't in the final decision, or that it was not mentioned throughout the proceeding at all, through discovery or cross-examination?
We could not find it in the final decision.
I could not find it anywhere either, so you're confirming. So did the company propose like a payroll capitalization ratio in the last rate case, or no?
I don't know the answer to that.
Okay, how about, is the company proposing at all a payroll capitalization ratio in this rate case?
Yes,
And what
I believe.
is that?
$3.4.
3.94%. Thank you. And
3.4.
okay, 0.4.
Yes.
Thank you. What would be a reason for a very low payroll capitalization ratio for Hazardville? Because I believe that percentage to be low compared to a lot of other utilities.
It's based on how much work we do with projects.
So would a heavy use of like contractors be one reason, or just, or would that not impact that?
No, this is all internal labor.
Okay.
The payroll capitalization is the labor portion. So if they did work on the project and
If I may, because I want to make sure we're on the same page. Perhaps, Mr. Zablowski, if you could first ask, what's your understanding of the payroll capitalization ratio? Because that way we know we're all talking about the same thing. Then you can follow up with your questions.
Okay. I guess differently, across the utilities that I've looked at least in recent past, that seems like a low number. That's why I'm just wondering if there's any specific reason for that.
No, most of our work is contracted out, so, you know, the labor for employees is not usually that high.
Thank you. Okay.
I'm gonna interrupt with one question. I'm just going back to the line of questioning about whether there was capitalized payroll in the last rate case. So my understanding of sort of where the revenue impact of capitalized payroll is that it ends up as a component of plant, right? So you would take like your overall actual expected payroll and reduce it by whatever amount of capitalized, that the remainder goes to expense, and then like what is capitalized you end up paying for as plant additions. Do you know whether that has been, even if it wasn't kind of addressed in the last rate case, do you know whether the plant additions request in the last rate case was inclusive of any capitalized payroll, and also whether the payroll O&M was adjusted to account for that? Even
I
if it
do
wasn't-
not know the answer.
Okay, thank you.
I'll move on to OCC 95, where OCC requested a listing of regulatory assets from the last rate case with their amortization schedules and the total that was paid included in rates for each to date. The company responded that all assets have been fully amortized as of November 2019. So is it correct to say that the company had these amortizations built into rates for the last 6 years or so still, as it has not come in for a rate case since November 2019?
I don't understand the question.
Okay. In the last rate case, right, there were regular assets that were amortized, correct?
Correct.
Okay. And the company stated in OCC 95, these have been fully amortized as of November 2019.
Correct.
Okay. But the current rates that are set in that last rate case still are those amortizations are still built into those rates, correct?
Yes.
Okay. Thank you. OCC 97, please. And specifically exhibits attachments E and D. These are audit reports for 2024 and 2023. We could start with 2024 exhibit E, I believe.
Go ahead.
On page 9, under cash and cash equivalent subsection, under summary of significant accounting policies, the audit stated, the company had on deposit at financial institutions cash and cash equivalents which exceeded current federal deposit insurance limitations. What is the current FDIC insurance limit?
250.
I would have to look that up.
Okay. But according to your audit, at least at certain points, you've exceeded that amount, it seems like. Is that correct?
I'm not sure. This is, the auditors do this, so I don't determine that.
Okay. Is there a way to limit the risk associated with having a balance over the FDIC insurance held at a bank?
Sorry, Mr. Zableski, did you want, the question about current FDIC insurance limit, the response was that the witness would have to look it up. Did you want to follow up with a read-in or a late file, or?
I think a read-in. I don't think we need a late file. It should be pretty quick.
Okay,
Look up.
so that would be W, read-in number W, read-in letter W.
1 moment.
Sure.
Thank you. Thank you, Mr. Zabowski.
So I have the answer. The current FDIC limit is 250,000. And a way to, you could open another account if you go over the 250 to mitigate risk.
Okay, so opening multiple accounts would
Yes.
take care of that risk?
Yeah.
Hold it, okay, thank you.
Just for the record, I'm gonna cross out W because we're running out of alphabet letters, so I don't wanna, we're just gonna pretend that I didn't ever enter that read-in. Let's keep W open. Okay.
Thank you. Does the company hold amounts that exceed the insurance on limited instances and not at all that frequently?
I'm
Like-
sorry.
Oh, yeah, I'll rephrase that for you. Essentially, does the company hold over that limit infrequently? Or is this like a constant occurrence when you have more than $250,000 in a single account?
Infrequently. It's
Infrequently?
infrequent.
Okay. If we move on to Exhibit D, under the same interrog, this is 2023 audit, but now page 10. Under same section, cash and cash equivalents. I see the same risk stated. Basically, the company is holding more cash in its accounts than federally insured. And it looks like in 2023, it was $751,000 over the limit. And in 2022, it was $1.6 over the limit.
Yes, that's correct.
It's just when the company said that it holds that amount of cash infrequently, but it shows up in audit at least 2 years in a row.
Well, I think that the 22 number is an anomaly because there was something, and I don't have all the details, but that happened where we received a large amount of money. No, I wasn't here then. Or, yeah, 22, I wasn't here. I'm here in 22. And, but I mean, all I can tell you is in the last year or so, we have not frequently exceeded the limit. So,
Is it?
but they're also probably talking about all total accounts.
Okay. So is it possible to obtain a file with like monthly cash balances per financial, like per account, per financial institution to be able to check whether this is in fact infrequent or, an occurrence that's actually frequent? Or like
For
20,
how long?
22, 23, 24? I don't think we need to go further than that.
Okay.
So I've lost track on which late file we're on.
That'd be late file 40.
Okay.
Have that as provide monthly cash balances per account for 22, 23, and 24.
Thank you. Could we go to interrogatory response OCC 102 next, please? And this is regarding rent lease expense.
102.
Okay. It looks like rent for both locations prior to the move to 481 Taylor Road was about 6,400 monthly. I took the 4,866 and combined that with the 1,545 from both locations prior to the move. The company stated that monthly rent increased to 9,000 immediately post move to 481 Taylor Road, if I'm reading the response correctly. Is that right?
Correct.
Okay. So would you agree that looks like a 40% increase in rent to change locations?
Yes.
Okay. When I multiply that difference by 12 to get to an annual number, I get about 31,500. Would you agree?
I'm sorry, what did you do?
So I took the difference between the old rent versus the rent
Oh, okay.
immediately post-move. And I got about 31,500 or so.
Because it was 6, yeah, yes.
Okay, thank you. And could you remind me which company owns the building currently?
Illinois Real Estate owns the building.
And who owns that company?
Avery Doing.
Thank you. The company stated that the new lease at the old location was subject to annual increases for 10 years. Is that right?
Where,
It just sounds like the company was, had to make a decision.
oh, yes, yes,
Whether
yes.
to stay at
Yeah.
the old location and sign a 10-year lease, which
Yes.
had some increases built into it also. Is it possible to obtain that proposal from the old landlord or owner of the building? If the company still has that, I imagine.
It may be possible to find,
If it's possible
proposed-
to
the
find.
proposed lease.
Yes.
I'm not sure. I mean, I have the existing, the old one, but I can certainly try to find a proposed one.
Could we have a late file, please? For a proposed lease prior to 481 Taylor Road move?
Yeah, that'll be late file 41, and I have it as proposed leases to continue tenancy at Hazard Avenue locations.
Perfect.
And maybe I'll kind of supplement the request to just add, I think if you can't locate the actual legal documents, if you have the numbers, like if you could just provide a narrative saying this is what we were comparing, like this was the 10-year outlook under, like, to stay at those locations. Would that satisfy OCC?
Absolutely.
Okay. That'll be LFE 41.
We could next move to OCC 103. And this one is regarding profit sharing. And I believe this is the one that has an attachment with the annual profit sharing numbers. So I did the annual change from one year to the next, and there's a disparity in the percent change for certain employees. And if I take out the ones that, have a 0 or 100%, there's nothing in 1 year. My results range anywhere from like 5.5% to 13% for certain employees. And could you speak a bit to how these are calculated? Is it just performance-based or is it position-based as well? I imagine there might be like a range for certain positions that's bigger. No?
That amount for all eligible gross wages. And so it's based on eligible gross wages. It's the same for everybody, same percentage. Somebody might have less in a year if they prorate. So if somebody was effective on 10/1 of 25, they would only get profit sharing for those October, November, December.
So those differences that I see from, let's say, 5%, 5.5% to 13% is just
Because of that, yeah, like, yes,
okay. Thank you.
you're welcome.
OCC 104. This one is regarding budgets. And I'm looking at the 2023 and 2024 budgets. And this is the first item that's listed. And this is purchase utility vehicles line item. I noticed here that the budget as of December 2023 and the next one as of December 2024, the cost of vehicle replacement increased from 65,000 to 95,000. And I was wondering if company can just substantiate like how it arrived at this increase, which it looks like a 45% increase.
The percentage increase or the proposed increase for purchase of a vehicle is based on probably the previous year's purchase price that we paid. We recently had to purchase a replacement vehicle for one that was damaged in an accident, and that vehicle, we were able to get a leftover vehicle at around, I think it totaled out to be about $80,000. if I was to purchase a brand new vehicle today, fully loaded utility body, all the works, lights, everything else, it's going to be close to $100,000.
Okay. That sort of leads to my next question, because every year's budget, the price for, let's say, an item like a utility vehicle or the radio transmitters seems to be exactly the same for the next 5 years.
Again, as I explained in previous questions, that this is a budget and deferred plan. This is not a budget, a capital budget that we use. And the only year that I would use would be the year of the actual date. So 23. So it's for planning purposes. The following 4 years are strictly for planning purposes. And every year that I have to redo these, everything will change accordingly. So in 2025 or 2026 and 7, whatever budget that I would use for purchase of a vehicle, I would carry out through those and the rest of those years. And then adjust that prior to approval for the plan from the board for the year.
Thank you. That explains that. OCC 111, and this is in regards to Rye Hill. There's been some cross about this prior. Is it correct to say that the company is collecting the spread between what the Rye Hill customers pay and what Connecticut Water charges Hazardville company?
Yes.
Okay. In this interrogatory, the company was asked to provide the impact on expenses associated with that revenue. Now, it doesn't look to me like the company here provided any expenses in its response, but I also heard that it will now do so in a late file. Is that correct?
I have late file 36 as please provide invoices showing purchase water costs from Connecticut Water for Rye Hill system in the test year. And then my recollection is there was a discussion afterwards about if there are necessary adjustments to late file 1 to indicate, to show, to break out that expense, or add it, depending on whether it's missing or just in another line item. I don't know if the panel agrees with that recollection, but that's what I remember.
So, I guess we want to make sure that the expenses in this application, submitted for recovery by the ratepayers, are already net of the Rye Hill system numbers. If we're backing out revenue, we also want to back out the expenses, right? So, because I assume there's some cost to accounting or engineering or customer service related to the Rye Hill system, correct? And that doesn't seem to be broken out anywhere. I mean, the current numbers could be already net of that. It's just that we can see. So if that late file 36, was it? Could show those expenses broken out, that'd be great.
So right now, late file 36 is just for the invoices for purchase water from Connecticut Water. You wanted to add?
Yes, all the associated expenses related to the Rye Hill system.
Okay, so I can add, please also identify and provide any other associated expenses associated with the Rye Hill system. Okay.
Thank you.
Thank you, Mr. Chairman. Mr. Zablowski, if you could just be a little bit more specific about what you're looking for when you say associated expenses.
Okay, so here's my worry, I guess. If the expenses that are in this application are not net of the Rye Hill system, essentially the ratepayers of Hazardville Water will be subsidizing the expenses of the Rye Hill system. That makes sense?
I think it does, but maybe the response could be if Ms. Wright or Mr. Sherwood could explain how you handle the Rye Hill system for rate-making purposes.
We can try.
In the late file?
No, right now.
No?
Sorry. I mean, if you'd rather do it in a late file, we can do it in a late file.
I think we'll put it in a late file
Yeah.
for that they asked. So.
Yeah.
All right, so why don't I just modified late file 36 to add the request. Please also identify and provide any other expenses associated with the Rye Hill system. And how about I add and a narrative explaining the rate making treatment for the Rye Hill system applied by the company. Does that work?
Yes.
And I guess I can make myself even more clear. If you're taking out the revenue from that system, but you're not taking the associated expenses, you're making your numbers look worse, technically speaking, than what they really are.
Correct, and that's what we have to verify.
Understood.
Yes.
Thank you. I have one question on non-revenue water, which I don't think has been brought up yet. And this is Exhibit M. If I'm looking at the correct numbers, in 2020, non-revenue water was 8.3%. In 2021, it was 9%, all good. 2022 was 13.5%, I think. Oh, 2022, sorry, was 13.5%, 23 was 7.7%, 24 was 8.2%. Just any reason for that big spike in 2020?
Sorry, can you tell me where you are?
Exhibit M.
M?
This is non-revenue water. There just seems to be a big spike in 2022 compared to the other,
Which, interrogatory?
it's not interrogatory, it was submitted in the original application, Exhibit M.
So Exhibit M from the SFR, I guess.
Yes.
Right here. Need this? Do you want to just?
if you're having trouble finding it, I can maybe help if you go to the public Pura docket and go to the application. There's a PDF. Okay.
I have it. I'm just trying to see if I can quickly get his answer for the increase. That was for 2024,
So
22.
22 was the jump, yeah.
If you look at the line that says main breaks, in 2022, there were 7 water main breaks and 5 service leaks. So you had increased loss of water or non-revenue water for those incidents. And
I'm sorry, but I'm in that Exhibit M, I'm on page 3 of 5. Where am I supposed to look for those?
so if you look at you're looking at the water production consumption for which is based off the annual report.
Mm-hmm.
Okay, so you're in 2022 or the year end 2022? The top header?
Yes.
Okay, so if you look about 2/3 of the way down the page,
Oh, I did.
description, non-estimated, non-revenue, description G or H.
P&H. I
main
see it.
breaks, or service line loss, or fire department, drills or fires. That's usually where, a majority of the non-revenue water, comes from, depending upon the year, or the number of incidents we have. We also, it's not necessarily, if you look down to 2024, it's not necessarily relative to, the number of breaks and service leaks, because we have to estimate how much water is lost per each leak, depending upon the time they come in, how long we think they were leaking before they were discovered. And we estimate the gallons that were lost for those main breaks or service leaks.
So in 2024, for those 15 main breaks,
Correct. 2024, we had an increase in main breaks. We had actually, we call it, in this thing is main breaks. They're probably mostly more like leaks that were discovered through our leak detection program, which was discussed earlier. And now we've gone since 2024, discovering all these leaks. We have now instituted a semi-annual or an annual half of the system as opposed to 1/5. So we're now doing 50 miles of mains as opposed to 20 every year. And to try to minimize what we see here, there's a chance that these 15 breaks were leaking. We don't know how long they were leaking since the last time that area was detected.
thank you so much for that one.
May I interject? A quick question. So does your non-revenue water include or exclude water for maintenance, like hydrant flushing, when you model it out?
It's included.
It's included in that number?
Correct.
Okay. Thank you.
Two more questions, I believe. Do we have a list of the board members filed in this application proceeding?
I believe so somewhere. Yes, it is somewhere here.
That is.
I feel silly asking for a reason to locate the list of the board members that has been filed in this application proceeding already.
I can look for it.
I have a related question. Are you still on board or
No.
may I?
Yes.
Okay, so I'm actually looking at that because I pulled out the annual report. So I actually have a couple questions for Mr. Sherwood related to that. So I'm seeing in the 2024 annual report, I'm seeing 8 board members. Does that sound right? 3 of whom are Avery's. Again, I'm not looking at the filing, I'm looking at the annual report, financial report to Pure. Has it been revised or?
I'm just trying to pull it up here.
Okay, sorry.
That's okay.
Take your time. I just had a few questions on this.
All papers are listed on this schedule.
What are you looking at right now? What document?
So I'm looking at the annual
Oh, the
financial
annual
report. Yeah.
I believe those were filed in response to RRU 67.
Oh, thank you. Yeah, I'm looking at, I believe, page 7.
Okay. Oh, it's OCC 67.
No. And RU 67, no.
Okay. So you were asking about the number of directors?
Yeah.
Yes. 1, 2, 3, 4, 5, 6. Yes, 8 is correct.
Okay, thank you. So for Mr. Sherwood though, so we've got 5 board members who are not family members. And so I'd just like to know, like, of your board of directors, are any of them attorneys?
Is Reggie?
Reggie.
Yeah.
The-
well,
I believe one was an
One's
attorney.
an attorney. Okay, how about,
Will be, sure.
oh, okay, good. How about finance or accounting? Do you have any board members within finance and accounting background?
Not that I'm aware
Okay. Engineering?
of. Actually, one does have somewhat of an accounting background. He used to work for the Treasury Department.
Oh, okay. Okay,
So,
good.
And then as far as.
Yeah,
Rob,
sorry, check your mic.
My mic's on.
you have to get
Did I-
closer then. Get closer.
Just lean in.
This one too. Sorry.
That's what she. And you, so you said some financial background.
Yes.
Okay. And then any community leaders? Like somebody who's like a, in the political world or like say a mayor or anybody like that?
One of the brothers was a professor at one of the colleges. I'm not sure exactly where, either in Rhode Island or Massachusetts.
Well, that's always something you got to look into, to see if they know anything. How about from a water utility background, particularly like a regulated water utility? Is any board members bring that, or actually water or energy, like a regulated utility background?
Not that I'm aware of, no.
Okay, thank you. That's all I need. Sorry, one more thing. I do notice on the report, and I don't know how to handle this, Mr. Chairman, but that page 7 of the report indicates a expense related to the board of 48,600, which didn't seem to reconcile with the Excel file. But I don't know if I have a question in there or not, but if you have anything to add about that in your other responses.
I don't know if it's in the other responses in my worksheet that I do. I mean, it's 48.6. I have the whole spreadsheet.
Okay, because I was looking at
It was all, and you were looking at the annual.
or the
annual
payroll.
report.
Yeah, it was the discrepancy between the payroll numbers and the annual report numbers for director fees. Because I think you said.
Well, those aren't, director's fees are not paid out of payroll.
Okay,
Those
so-
aren't the payroll wages are
So
totally
it all,
separate. Yes.
you've reconciled that.
Mhm. Yes.
Good, perfect, thank you.
That was my last question, but I think Mr. Apollonia has one more.
Yes, one more question here. So has your financial reporting requirements changed within the last 5 years?
Not that I'm aware of, other than well, we now consolidate, we didn't consolidate the financials until 2022. They all had separate financial statements. As of 2022, we now do them separate and consolidated with ADC. Is that what you're talking about? Or are you talking about the annual?
Yes, I'm just wondering if it's like increased the workload on your financial staff in the last 5 years. Have you increased?
We have increased our workload and I mean, I've been there 2 years, but I know that we're busy and we're all, still learning. So, in the time you need to learn this stuff and everything. So it's critical to have the staffing that we have to get everything done.
Okay, thank you. That's all I have.
Sorry, one more. I think this is Schedule C 3.1, payroll by position. Are all of those currently filled? C 3.1, payroll by position.
Positions are all filled in this.
Uh, Technician number 5, is that one filled? It is? Okay.
Sorry, yes, that's been filled. I believe it was an interrogatory response that it was filled in September after this exhibit was filed.
Okay, because I believe the August updates still had that open. Okay, thank you.
All right, thank you, Chairman. That's process.
All right, do we have any other I don't have questions, but do any commissioners have any? All right, it's 4:52. Attorney Nigro, I'm gonna give you a Hail Mary opportunity. Do you think you can do your cross out of order? Rate design's next, but since we have 8 minutes, do you think Deep can conduct its rate design in the next 8 minutes, or would you like to come back tomorrow? Sorry?
Let's live it.
Sure. If he can, I mean, if Mr. Annis can get it done in 8 minutes, then we can bang it out. And I said tomorrow, I meant Thursday. Don't come back tomorrow. Unless you want to watch Charter Cox late files hearing.
I'll be there.
Same cast for you.
Oh, you do? Which ones?
I should have also asked, I apologize, Mr. Bogan, is there any objection to taking Deep's Cross out of order if they can get it done quickly?
I defer to Mr. Ennis anytime.
Thank you.
I'm told we do have 2 read-ins, if you want to take those now.
Sure.
Read-in U was asking for a copy of the lease agreement, which is in OCC 113A PDF submission.
Hold on, what's that?
OCC 113.
113A PDF.
Oh, got it.
So that is the lease agreement.
Thank you. That satisfies read-in U.
Don't even have copy of lease agreement.
Wait on that. Can I proceed, or David, you need me to wait for you?
1 second.
Okay.
Thank you. Oh, there it is.
I gotta keep him happy. I gotta keep you happy, so you don't. Okay. I'm not used to attorneys. Okay, for read-in S, which was the chemicals, asking to change that one. Well, we have a submission. So that was RRU 96, and then refer the chemicals to RRU 127, where all units are converted into pounds. So in RRU 127, it will show those all correct, and they should be in pounds, not
Gallons.
gallons. And with, I don't know if this was part of that. Deep expenses, they were asking about the deep expenses being part of included in amortization. And although they're included on the worksheet, we did not include amortization for that.
Okay.
So it's not included in both amortization and expense. And that's
Okay.
all I got.
That was read-in T, that second one, so that
Okay.
combined satisfies S and T. Thank you.
And you.
Yep, and U is also.
US and T. Thank you.
Thank you. Mr. Annis, I'm told that the UConn game starts in 4 minutes, so no pressure or anything. But you can start your rate design cross.
Okay, thank you. And sorry, I didn't get a chance to put my tie on. I was summoned quickly, so I apologize. Thank you. So we have some quick questions on rate design. We asked you guys, I guess, 3 interrogatory questions trying to get at if we can have an inclining marginal block rate. And so I'll just quickly repeat, lay the foundation here. You guys could do, under your billing system, an increasing block rate, a marginal block rate. You have the capability of doing that on residential customers only?
Correct.
Okay. And I guess we had asked a question, if you could find the highest, the amount of usage of your highest percentage residential users of how many gallons per month they use. But the answer we got was we haven't done a cost of service study, or we don't have the right billing. But so I was wondering if you could expand upon that question a little bit of your capability of doing it. We have a suggestion of way to do it if.
We believe in order to find that, we would have to go back to our billing software and ask them to create a program that we could run to get that information. There are costs associated with doing those. We try to minimize how many times we ask them to create a certain program for us to be able to run. They will do it, but there's costs associated with it.
Okay, let's see if we can find a way around that. Do you guys have the ability to look at like the top 1% of bills or 5% of residential customers without running the costly?
I'd have to check on that. I'm not sure today.
Okay, so I guess I'll ask for a read-in. Is a read-in on can you guys pull without significant cost the top 5 and 1% of residential users and bills, and so the bill amount? And
it is just residentials.
Just residential.
Is that top 5%?
Yes, top 5% and top 1%. And that's dollar bills, like how much of the bills. So it should be, and then from there, we would ask a subsequent question of could you look at the average usage of water, monthly usage of water for those customers? If once you pull those bills, is it easy to then, because it shouldn't be more than a couple of handfuls of customers your size.
We bill quarterly. So as far as trying to pull the monthlies, this is where we were kind of, caught between, we do have a minimal amount of residential monthlies, but there's more quarterly customers. So we're not going to be able to do it by a monthly basis unless we just extrapolate it out an average. And that wouldn't work because their usage is going to go up seasonally.
Exactly right. If you could parse those out and do those separately, that would be fine. So this is the 1% bills for monthly, this is it for quarterly, and then do the average usage for monthly and then average usage for quarterly separately.
Okay.
And I guess for that, we'll have a read-in on your capability of doing that.
Mr. Chairman, I do have a question of Mr. Annis, but I'll defer to Commissioner Cheeseman.
Sure. I just want to clarify. So I entered that as a read-in, and as the read-in, the question of like whether the company's able to get this information, and then if the answer is yes, would there be like a follow-up late file? Is that
that would be good. I'll want to ask questions on the cost of to do it if we needed to do that more system. I don't want to. I have to consider whether my leadership would want us to even request that to be incurred.
So we'll leave it as a read-in now. That's read-in X saying, can the company pull without significant cost the top 5% and top 1% of residential users' bills? Could the average monthly usage and quarterly usage of those customers be provided?
That sounds excellent.
Okay.
And then the answer is no. What is the cost to do the kind of have their billing system do it for automatically?
Okay, I will add that onto read-in X. And Commissioner Cheeseman, please.
Yes, I suppose my question was to you, and given Mr. Sherwood's response, water consumption can vary greatly depending on the time of year. I mean, if you have a large, lawn and you're, in gardens, your summer usage. On the other hand, if you've got a big family and everybody's home, So do you have a specific time period, or are you just looking to pick at random a 3-month period, and out of that 3-month period, look at the highest 1% and 5%?
That's an excellent question. I guess our goal is the summer months. It's targeting irrigation. So thank you, Commissioner Cheeseman, for that. So we would look for the June, July, August months or whatever quarter? How do you, I'll ask that, Mr. Sherwood, help me out here.
The only reason I say that, and I'll put it out, I'll go out there, is June, July, August, and you will also probably look for September. Well, no, it would be July, August, September, October, November, December. Believe it or not, with these past few seasons, we've been producing more water in September and October due to people wanting to keep their lawns longer. And especially we've had a drier fall than we've had in the spring. So June has been sometimes lower than we'd like to see. And then we see more in September and October. So just looking at those numbers, if I gave you June, July, and August, it may be skewed.
Pick up September and October as well. So I guess I want to make, so I guess the overall goal we're trying to do is we're likely to make a request or recommendation for an inclining block rate. And at this time around to get the very, very highest users that are doing lawn irrigation and residential. And so we would like for that price to have an inclining price on those users on their marginal use. So any information you can give, we're trying to get that information to ask you to do that. And we're not looking to significantly change the revenues we're getting this year. So we want to get the very tippy top. So we're not significantly moving the revenue requirements, and just to acclimate the customers, because you're going from a declining block rate currently to we are asking for an incline. So we want to do very marginal, just so the customers can start doing it and catch up to the other the other water companies in the state. So that is a policy position of DEEP, is to try to get at that irrigation discretionary use water and price that. So that's what we're trying to do. And so hopefully the information you can get us, come back to us, and any information you have that could help us get there and help us put a recommendation to the authority, that would be greatly appreciated.
Yeah, if I could just,
Sorry.
pick up on the same thread. I think you do have the data in your pumping data. You're going exactly where I was, which is look at that monthly pumping data and start to show the, capacity utilization by month. But then my related question to all of this is that price signals, because they are seasonally, we're trying to get to that seasonal usage. Quarterly billing is kind of not helpful, So I guess my question would be, have you considered monthly billing, and do you have an estimate of the cost of that?
We have discussed monthly billing for the customers in Hazardville Water. We have not explored the cost for monthly billing. There is going to be a substantial cost if you're as opposed to sending out approximately, let's say, 3,000 bills every month with our quarterly customers, monthly customers. You'd be talking about sending out 8,000 approximately, or 75, a little more than 7,500 every month. Your increased cost and postage, printing the bills, everything would go up. Now, that being said, we did do that with our sister company in Jewett City many years ago, and that was not well received. Only because they thought they would rather stay on a quarterly bill. Although we felt then for Jewett City that if you're receiving a monthly bill like you do your electric, telephone, everything else, that the hit would be less, because if it's $25 every month, then it's $75 a quarter. It's easier to budget to $25 per month. It was met with a lot of resistance, although it has tapered off and we still continue monthly. So we have discussed that.
That's helpful. But are you 100% paper bills?
No.
No. What percentage are electronic?
I'd have to get that for you. I'm not exactly sure. There are some people that do not receive a bill. They receive an electronic invoice.
Because that would certainly affect the cost of implementing a monthly.
It can. But then your increased costs after that for past due notices and shut-off notices will increase. Right now, we send out approximately, let's say, between past due and shut-off notices every month, 400.
Okay.
So that would increase.
Yeah, okay, good. And I just want to reiterate that rate design is revenue neutral. It's not a way to, that would have to be the objective, but it is, but it raises an important issue about cost allocation and rate design, and both in terms of equity and efficiency. So it is a worthy topic to raise for further discussion. So thank you.
And thank you, Commissioner Chair. So I think when we get those read-ins and then hopefully a follow-up late file, and from there, we'll be able to discuss it further at the late file hearing, I hope. So I think that answers what I want, and hopefully you only missed the first minute of the UConn game, but
7 minutes. Thank you. And Attorney Bogan, did you, okay.
I'm good. Thank you.
And lastly, Commissioner Beecher, you had asked about the percentage of bills that are electronic or the percentage that are non-paper. Did you want that as a read-in? Or, okay, that would be read-in Y. I just have it as percentage of bills that are not paper. I thought maybe that was an easier way to phrase it, because I assume some people get both electronic and paper billing. And just to clear up what I have for read-in X, which was Deep's request, because it's a long one. Can the company pull without significant cost the top 5% and top 1% of residential users' bills? Could the average monthly and quarterly usage of those customers be provided? If the company cannot provide this information without significant cost, could the company provide a cost estimate? That covers.
excellent. Thank you very much, Chairman.
Okay. All right, I think if there's no further administrative matters, we can recess until Thursday morning at 10 a.m.
Thank you.
Thank you.